The first standard for discussion in corporate accounting is Ind AS 1, sir. Ind AS 1. What is Ind AS 1? Presentation of financial statements. So the name itself is saying it is all about financial statements. When you prepare financial statements, how presentation should be made in the financial statements. Okay. Sir, basically this standard can be divided into two parts, sir. So this standard basically consists of two parts, I can say. The first part is about financial statements. Like what is the meaning of financial statements? So what is general purpose financial statements? Objectives of financial statements? And what are the features of general features of financial statements? See, all these things are there in part 1. Part 2, disclosures. It's a theory based thing. So entire standard is theory oriented only, but the very easy standard. So with minimum time you can complete this. And disclosure requirements, what disclosures we need to make in the financial statements. That is what this standard is all about. Now, so what we are going to learn in this standard, first of all, sir, what is the object of Ind AS 1? Why Ind AS 1 has been brought? See, simple, to provide the principles for preparation of financial statements. So when you are preparing financial statements, certain principles you need to follow, right? To provide that principles, this accounting standard 1, Ind AS 1 has been brought. And this is the minimum requirement. So whenever you are preparing financial statements, you need to comply with Ind AS 1, and this is minimum requirement. And of course, if you want to make better presentation, if you want to give more information than what is required by Ind AS 1, you are most welcome. Okay. Now this is the object of Ind AS 1. Now applicability. Sir, Ind AS 1, is it applicable to every organization? Yes. Be it a commercial organization like profit making entity or non-profit making entity, NPOs, section 8 companies. For everyone, this standard is applicable. Of course, we have to make a suitable changes to the terms when you are applying this standard to the non-profit entities, because the terminology of the components of financial statements in non-profit organizations may be a little bit different. So therefore, basically this standard will prescribe keeping in view the profit making entities. I mean, the terminology what we used for profit making entities. And of course, this is applicable equally for non-profit making entities also. This presentation of financial statements Ind AS 1 should be, the principles of Ind AS 1 is applicable for non-profit making entity also. Next, this it applies to entity following Ind AS 27, that is consolidated financial statements. Sir, when you are preparing financial statements, you suppose if you are a parent company, you will prepare consolidated financial statements, right? Now when you are preparing consolidated financial statements as a parent company, then also this Ind AS 1 is applicable. Okay. And but the most important point is, this AS is not applicable for interim financial reporting as per Ind AS 34. Remember, this can be asked as an MCQ. So for interim financial reporting, this standard is not applicable. See, what is this interim financial reporting? See, these listed companies, quarterly they will prepare financial statements, or half yearly sometimes they will prepare financial statements. Now see, whenever they make any interim financial reporting, interim financial statements, so there is a separate standard, Ind AS 34. So this standard is not applicable for interim financial reporting. So remember this. For normal financial statement, this standard is applicable. Every year we prepare that one. But for interim financial reporting, Ind AS 34, this standard is not applicable. Now next thing, sir, when you take financial statements, there are two things, sir. What are those? General purpose financial statements, special purpose financial statements. Now remember, this standard is applicable for general purpose financial statements, not for specific purpose financial statements. So what is this general purpose financial statements? See, generally at the end of the year, every entity will prepare financial statements not to cater the information needs of everybody. So to cater information needs of all users of financial statements. That is called general purpose financial statements. Like every entity at the end of the year, they will prepare financial statements. That is general purpose financial statements. Now, special purpose financial statements. See, for specific users, to satisfy the information needs of specific users, we will prepare financial statements. That is called specific purpose financial statements. Like for example, we are submitting a financial statements for bank for loan. Okay. Now, in that case, the financial statements what we are preparing is preparing for a particular purpose. That is for submitting to the bank for the proposal of the loan, the project loan from the bank. Now, in that case, this is called specific purpose financial statements, which we issue or to specific entity users, specific entity or users. Okay. Now that is called special purpose financial statements. So Ind AS 1 objective. What is object of Ind AS 1? To provide principles for preparation of financial statements, and this standard provides you the minimum requirements. Okay. Now applicability. Sir, is this standard applicable to everybody? Yes, profit, non-profit. But and even those entities who prepare consolidated financial statements like parent company, as per Ind AS 27, this standard is applicable. And remember, this standard is not applicable for interim financial reporting. That is Ind AS 34. And financial statements are two types: general purpose financial statements, specific purpose financial statements. See, for general purpose financial statements, this standard is applicable. That means when you prepare financial statements to cater the needs of a specific, everybody, that is called general purpose financial statements. When you prepare financial statements to cater the needs of the specific entity or users, that is called general purpose financial statements. Specific purpose financial statements, for them, this standard is not applicable. Okay, object to applicability. Now, first one we completed objective of the standard and then applicability. Next, again, what is the basic object of AS1? To provide principles for preparation of financial statements. I told na. See, another objective behind preparation of this standard is to provide financial information. See, we want financial information. Okay. So we want financial position, financial position, and also financial performance. See, every organization at the end of the year, they want to know their performance, their financial position. To know the financial position, what we prepare? Balance sheet. And to know the financial performance, we prepare what? P&L account. Now, balance sheet consists of what? Assets, liabilities, equity. P&L account consisting incomes, expenses, gains, losses. So to wide range of users so that they can take informed decisions. So what is the object of Ind AS 1? Why they are giving you the principles for preparation of financial statements? Because see, at the end of the year, you need to prepare financial statements to provide financial position and financial performance to the users of financial statements so that they can take informed decisions. So that for that, the principles is prescribed by Ind AS 1. Okay. Next, complete set of financial statements. If you read Ind AS 1, sir, so what are the financial statements which is, complete, what is financial statements? Financial statements includes the following. First one, balance sheet. As at the end of the financial year, we prepare balance sheet. And then P&L account, we prepare P&L account for the financial year. And other comprehensive income statement for the period. See, this is very, very important. Generally, if you read the Companies Act or if you read normal accounting standard, financial statements includes balance sheet, P&L account. But see here, other comprehensive income statement. See, this is as per Ind AS 1. So, along with P&L account, you have to prepare other comprehensive income statement for the period. So, remember, this is very important. Next, cash flow statement for the period. So, we need to prepare cash flow statement for the period. So, whenever you are preparing cash flow statement, so this standard is applicable. And any statement showing changes in equity. So, this is also part of financial statements. And any notes to accounts forming part of the above. I think these 5 things we know. Only new thing is what? Other comprehensive income. Okay. Now, along with that, as per Ind AS 1, balance sheet of the preceding financial year. When the accounting policy is applied retrospectively, this is also important. You can get this in exams. So they may ask a question. So what are the components, set of financial statements as per Ind AS 1? You have to write balance sheet, P&L plus other comprehensive income. Next, what is that? Cash flow statement. Fourth, statement showing changes in equity. Fifth, notes to accounts forming part of the above. Sixth, balance sheet of the preceding financial year. Balance sheet of what? Preceding financial year. So, sir, generally, why we need to give balance sheet of the preceding financial year? Is it also part of the set of financial statement? Yes. When you apply accounting policy retrospectively, when accounting policy applied prospectively, no problem. Retrospectively, if you apply accounting policy, now because of this retrospective application, certain financial statements of the previous years also get affected, right? Now that's why you need to prepare the balance sheet of the preceding financial year, and now you need to include that as a part of the current year financial statements. So remember 6 things. So this is complete set of financial statements as per Ind AS 1. Ind AS 1, see, most of the students are of the opinion that normal accounting standard, Ind AS, both are same. See, maybe most of the times 50 to 60% same. So there is a difference also. See, the examiner, he will concentrate more on the differences. He knows that there is a uniformity between normal standards and Indian accounting standards. But so he focuses more on the differences. So that's why you have to be very careful. Okay, this other comprehensive income statement is not there as per normal accounting standard, or when you read the Companies Act financial statements definition, so this will not there, and as other comprehensive income is not there as a part of financial statement, but it is there as per Ind AS 1. And similarly, this balance sheet of the preceding financial year, generally we won't include it as a part of current year financial statements, but this balance sheet of the preceding financial year, when you apply accounting policy retrospectively, then you should include it. Next, what are the general features of financial statements, sir? So I told you, see, this standard is all about two things. One is requirements of financial statements, another one is disclosures. Now, what are the general features of financial statements? See, true and fair view, going concern, accrual, consistency, comparative information, materiality, offsetting, frequency of reporting. You should remember this. They may ask a question. Explain general features of financial statements as per Ind AS 1. Or maybe asked as an MCQ also. What are the following is the general features of financial statement as per Ind AS 1. So out of this 8, anyone can be given. So the right answer should be lies with this 8 only. So you can easily remember these are the normal things we use. True and fair view, first one. And then going concern, you know this. Accrual concept, you know this. Consistency concept, you know this. So true and fair view, going concern, accrual, consistency, comparative information, materiality, offsetting, frequency of reporting. So generally these are the general features of financial statements. Can you tell me? True and fair view, going concern, accrual, consistency, comparative information, materiality, offsetting, frequency of reporting. So these are the general features of financial statements. So if you read Nana properly, see here, Ind AS 1, I told you, the first part is these 4 topics. First, meaning of financial statements. We have discussed meaning of financial statements. Those 6 is a complete set of financial statements. General purpose financial statements, which we prepared to cater the information needs of everybody. Okay, this standard is applicable for general purpose financial statements. Objectives also we discussed. The main objective is to provide principles for preparation of financial statements and minimum disclosure requirements. Next, general features of financial statements. Just now we discussed. What are the general features of financial statements? So true and fair view. Okay, and accrual concept, consistency concept, going concern concept, comparative information, materiality, offsetting, frequency of reporting. All these are general features of financial statements. If you read the standard, entire standard I have covered as a summary. Okay, see here. First, we discussed the applicability. I told you this is applicable for profit oriented undertakings, and then as well as non-profit entities. And also I said this is applicable for consolidated financial statements also. And when you prepare summarized financial statements by Ind AS 34, that is interim financial reporting, this is important. They may ask a question. So see, most of the students are leaving Ind AS. No, you just listen to this revision, more than sufficient. Listen it 2 or 3 times, and then directly go and write the exams. So I think, of course, you have to solve some questions, but at least something is better than nothing. Okay. So this is the first topic we discussed, and then meaning also I discussed. General purpose financial statements, specific purpose financial statements, objectives we discussed, financial position, financial performance to wide range of users of financial statements, complete set of financial statements we discussed, balance sheet, P&L, statement showing changes in equity, cash flows, notes, and balance sheet at the beginning of the preceding period. This is very, very important, I told. Okay. Next, what are the general features of financial statement? This topic also I discussed. True and fair view, going concern, accrual basis, materiality, offsetting, frequency of reporting, comparative information, consistency of presentation. Now, one by one, suppose true and fair view. You know the financial statement should contain all truth and fair presentation. Whatever you are reporting, incomes, expenses, losses, gains, so everything should be true. So that is the first feature the financial statement should have. Always remember the financial statement should have true and fair view. Now, second one, going concern. You know this. So India's one says when another feature the financial statement should have is going concern. That means when you prepare financial statements, you make an assumption that the organization is continue for foreseeable future. It is neither have the intention nor have the necessity to curtail its operations. So going concern, keeping going concern in mind, you should prepare financial statements. Then accrual basis, you know this. Expenses, incomes will be recognized as and when they accrued, irrespective whether they will be received or not, or they will be paid or not. Materiality and aggregation. Sir, what is this materiality? See, the financial statement should give importance to all material items. All material items should be disclosed separately in the financial statements, presented separately. And those which are not material, no need to disclose them separately. So, offsetting. The entity shall not offset assets and liabilities or incomes and expenses unless required or permitted by an Ind AS. Important. So they may ask, what is this offsetting? See, you cannot set off assets and liabilities. If it is required by law, you can. Similarly, incomes and expenses, you cannot set off. This is also financial statement should have. See, all these are minimum requirements. All these features are part of financial statement as per Ind AS 1. Next, frequency. Sir, how frequently we need to report the financial statements? See, an entity shall present a complete set of financial statements at least annually. Every year once you need to prepare the financial statements. Suppose if because of any reason the period can be longer than 1 year or can be shorter than 1 year also. Okay. So, but when the period is less than 12 months or more than 12 months, you should prescribe the reason for using the longer or shorter period, and the fact that the amount presented in the financial statements are not entirely comparable. So, see, suppose for example, when you prepare financial statements for, suppose you selected 15 months. Now, how can you compare financial statements which is having the frequency of 12 months? Suppose, for example, last year 12 months, this year 15 months. Can you compare these two? No. Suppose my financial statements is for 15 months. Now, other company financial statements are 12 months. Can I compare? No. So, that is what they are saying. The frequency of reporting. And then comparative information. Minimum comparative information, additional comparative information that you need to give. So, ignore this. And consistency. See, whenever you are preparing financial statements, you follow some policies, right? You follow some consistency. Next. Now, disclosures as per Ind AS 1. See, what we need to disclose as per Ind AS 1. I told you this standard has two parts. First part is about financial statements. Second part is about disclosures. Significant accounting policies. All accounting policies, whatever we adopted in the preparation and presentation of financial statements, we will disclose. Okay. So, an entity should disclose in the summary of significant accounting policies, the measurement basis used in preparing financial statements, and other accounting policies used that are relevant to an understanding of the financial statements. So, we have to disclose this. What are the significant accounting policies we adopted in the preparation and presentation of financial statements that we need to disclose? And this is similar to normal accounting standard or normal accounting standard 1. And also next, sources of estimated uncertainty. So suppose for example, if you are making any estimations now relating to any assets or any liabilities, generally we sometimes we make some estimations, right? Accounting estimates. So based on what information you are making these estimations, the entity shall disclose. So the entity shall disclose about the assumptions it takes about the future and other major sources of estimation of uncertainty at the end of the reporting period that have significant risk of resulting in material adjustment to the carrying amount of assets and liabilities within the next financial year. Suppose for example, see, there is a liability. Now whether a liability will come or not, you don't know, but you are making an estimation, right? So if whatever you are making assumption right now according to that assumption, how much is the liability, and if that will be the liability, is it affecting the financial statement significantly, then we need to disclose it. So and also we need to disclose the nature and what is the carrying amount as at the end of the reporting period. And capital management policies, see, along with the above information, the company shall also disclose the information that enables the users of its financial statements to evaluate the entity's objectives, policies, and process for managing capital. See, managing capital. Accordingly, the entity shall disclose information relating to qualitative aspects of capital, quantitative aspects of capital, how much capital we brought, how much we used for this purpose, so how much capital we redeemed. So management of both the aspects, externally imposed restriction on capital and violation of those rules. So relating to share capital, what are the policies you are following? Disclose it. And other information regarding financial instruments you need to disclose, and other disclosures. Any other points you feel, you can disclose it. So if you means these are the points. Entity shall disclose in the notes to accounts the following: the amounts of dividend proposed or declared, the amount of any cumulative preference dividend not recognized, not that much important. See how you have to read this standard now comprehensively, not entirely. So overview. If you read overview, that is more than sufficient as far as this standard is concerned. So once again, I will quickly recapitulate. You remember this much. I think approximately it will take 30 minutes to you. So you listen 30 minutes 2 or 3 times. That's more than sufficient. So Ind AS 1 is about presentation of financial statements. There are 2 parts in this standard, part 1 and part 2. Part 1 talks about financial statements. Part 2, disclosure requirements in financial statements. First of all, what is Ind AS objective? The objective is to provide principles for preparation of financial statements, and this is a minimum requirement standard. And applicability, it is applicable for both profit, non-profit entities, and it is applied to even an entity which is preparing consolidated financial statements. But this is not applicable for the interim financial reporting. And this is applicable for general purpose financial statements, not for specific purpose financial statements. And the objective of this standard is to provide financial position as well as financial performance to wide range of users of financial statements so that they can take more informed decisions. And what is a complete set of financial statements? Balance sheet, P&L account, other comprehensive income statement, cash flow statement, statement showing changes in equity, notes to accounts, and balance sheet of the preceding financial year if you apply any accounting policy retrospectively. And what are the general features of financial statements? True and fair view, going concern, accrual, consistency, comparative information, materiality, offsetting, frequency of reporting. So this is what this standard is all about. And disclosure requirements. So what points we need to disclose? Simply you remember all significant accounting policies, whatever we followed in the preparation and presentation of financial statements, you disclose it. And also what are the sources of estimated uncertainty? If you are making any accounting estimates, what is the sources of that estimation? What is the nature of the assumptions you make? So all those things you disclose. And also capital management policies you disclose. So suppose if at all there is a question from Ind AS 1, explain the disclosure requirements, you just write these headings. Significant accounting policy should be disclosed, sources of estimated uncertainty you should disclose, capital management policies, information regarding financial instruments, so other disclosures. So 5 headings you remember. And also features of financial statements, sir, you remember the headings. Okay, true and fair view, going concern, accrual, materiality, offsetting, frequency of reporting, comparative information. So you remember these headings and write one simple lines in your words in examination. Suppose if at all a question came from this one, suppose general features of financial statements, write any 5. So I think you can easily write Put a heading, for example, true and fair view. Financial statement should reflect true and fair view. That's it. Now going concern. When you prepare financial statements, we should make an assumption that the organization will continue for future. So next, accrual. All incomes and expenses will be recognized on accrual basis, irrespective of cash received or paid. Next, consistency. When we prepare financial statements, the accounting policy should be consistently applied. Like that, in your own words, you write. But the main thing is the heading. See, the person who is correcting the paper, he will see first going concern. The moment he sees going concern, he will directly give the mark, because going concern, the word itself is main there, because in the key itself they will mention like that. Okay. So that's it, India's one. So very simple standard. Don't leave this standard. Spend 30 minutes, 25 to 30 minutes. Entire standard will be done. Don't spend much more than that. Don't try to read everything theory. You remember it. So as a bird's eye view, as a summary, whatever here I have given, I have when I'm teaching the class, I have written all this summary. Okay. From there, I am explaining it. Now for this marathon. Okay. Hope you enjoy India's 1. Now I'm going to discuss India's 2. Now the next standard for discussion is India's 2, sir. India's 2 is about inventories. Like normal accounting standard 2 is also inventories. India's 2 is also inventories, so that easily you can remember the name. Okay. Normal AS2 and India's 2 both are talks about inventories only. Okay. Now, first of all, what we are going to learn in this chapter, see, inventory and its valuation. So that is what the main thing about this standard. So to make the valuation of inventory, what are all the things we have to learn? Everything will be provided under this standard. See, first we should learn what is inventory, and then what is the objective of the standard, scope of the standard. Now that means whether the standard is going to cover all types of inventories, that we have to learn in scope, and how to measure the inventories, how to value them in the balance sheet at the end of the year, and generally cost or NRV, whichever is lower, we know that, and how to determine the cost, how to determine the NRV, and in case there is joint products and byproducts, how to make the inventory valuation, and what are the cost formulas available, and disclosures. So basically this is what this standard is all about. So very simple standard. Now let us start with the inventory definition. Sir, first of all, what is inventory, sir? See, standard says inventories are assets held for sale in the ordinary course of the business. See, whatever you held for sale in the ordinary course of the business, that is your inventory. Like for example, finished goods. Suppose if I am a manufacturer, I will manufacture the items and which I am held for sale in the ordinary course of the business, that is my finished goods. Suppose if I am a trader, so stock in trade is held for sale, so that is my inventory. So in the process of production for such sale, so sometimes the items are not yet completed, that means they are under the semi-finished stage. So once they have completed, they will also held for sale. So in the process of production, like for example work in progress, they are also inventories. And then any form of materials or supplies to be consumed in the production process or in rendering of services. See, suppose for example if I am a manufacturer, so whatever the materials, whatever the supplies I will consume in the production process, so they are also inventories. Like for example raw material. So raw material is the materials which we consume in the production process. Different kinds of oils, different kinds of consumables, different kinds of tools, so loose tools. So all these things we consume in the normal production process, they are also inventories. Please understand, they are also inventories. Basically in the factory, whatever we use in the production, generally what items we consume in the production, they are all inventories. So anything held for sale in the ordinary course of the business, anything in the process of production for such sale, and then anything is materials or supplies to be consumed in the production process, or rendering of services. See, suppose if I am a service provider, to render my services, what are the materials or supplies I am consuming, they are also my inventories. See, suppose for example I am a service provider, like for example internet service provider. Now to provide these internet services, what material supplies I am consuming? So for example, for installation of this equipment, so wires, so wiring system, cable systems, so all these things I will purchase and I will use it for installation, right? So they are also what? Supplies, materials consumed in the rendering of services. So if I am a service provider, whatever materials or supplies I will consume in the production process, So they are also my inventories. So this is the definition of inventories. So finished goods, work in progress, raw material. These three put together we can call them as inventories. Now see, suppose if you are a manufacturer, you will have all these three things. Sir, I am a trader, I am not a manufacturer. Then see, you don't have work in progress, raw material, finished goods. We call them as stock in trade. Whatever you deal, whatever the items you are dealing, purchasing and selling. So stock in trade, we call them as what? Stock in trade. Okay. Okay. Now, what is the object of account Ind AS 2? Simple. The main object is to provide the basis for measurement of inventories. Sir, how to measure the inventory? To provide the basis for that inventory valuation. See, we all know one thing. What is that? Inventories or assets. See, just now in definition also we have seen inventories or assets. Assets where we will show balance sheet. Now at what value you will show? So to measure the value of inventory, the base is provided by Ind AS 2. So the basic object is to provide the principles for measurement of inventories. That is, we keeping that object in mind, they have brought Ind AS 2. Okay. Sir, scope is very, very important, sir. You can expect an MCQ from this scope. Okay. Now listen to me carefully. Sir, whether this standard is applicable to all kinds of inventory valuation, except there are few exceptions are there. See, standard is not applicable for valuation of all inventories. They have given few exceptions. Now, see, this standard is applicable to all inventories except these other things. One is financial instruments. So financial instruments, we have a separate accounting standard for financial instruments. So whenever there is a specific accounting standard, follow that specific accounting standard. Don't follow general accounting standard. See, for example, for financial instruments, you have Ind AS 32, Ind AS 109. So therefore you follow that standard, not Ind AS 2. So whenever there is a specific standard, follow that, not the general standard. See, this Ind AS 2 is a general accounting standard which talks about inventory valuation. So therefore, first exception, this Ind AS 2 is not applicable. Ind AS 2 is not applicable. So not applicable to what? Financial instruments. Why, sir? Because for financial instruments, there is a separate standard. Second thing, any biological assets relating to agriculture activity and agriculture produce at the point of harvest. This is also very, very important. The biological assets related to agriculture activity plus agriculture produce till the stage of harvesting. See, what is this biological assets, sir? Living animals and plants relating to agricultural activity. See, if you take normal accounting standards, sir, there is a standard called AS 10 which exclusively talks about PPE. There you have one exception. This standard is not applicable to biological assets like that, living animals and plants. Now, why? See, they thought for this biological assets, they want to bring a separate standard. So if you see Ind AS, you have a separate standard relating to agriculture activity. So that's why it is an exception here. See, biological assets relating to agricultural activity like living animals and plants. So whatever the animals we used in agriculture for agro farming. So those animals and plants, living animals and plants, so they have a separate Ind AS. So therefore this standard is not applicable. So remember this, they may ask MCQ also. Whether Ind AS 2 is applicable to biological assets relating to agriculture activity. Answer is no, it is not applicable because there is a separate standard. And also any biological assets relating to agriculture produce. See, suppose for example any agriculture produce like for example paddy, or all these things. So paddy. Now relating to this agriculture produce, whatever the biological assets you are using. Okay. Now for them also there is a separate standard. So therefore Ind AS 2 is not applicable. So in scope, first you need to learn this Ind AS 2 is not applicable to financial instruments because for financial instruments there is a separate standard. Second, biological assets relating to agriculture activity plus agriculture produce. Next, sir, one more important thing, sir, in scope, this standard does not applicable. Already two things are provided. Again, they are selling two more things. This standard does not apply to the measurement of inventories held by agriculture and forest products, mineral products. See here. So any agriculture and forest products, Any minerals and mineral products, to the extent they are valued at net realizable value, this standard is not applicable. So any agriculture products, any forest products, any mineral products, this standard is not applicable. Remember, but when they are not applicable, when Ind AS 2 is not applicable, to the extent they are valued at net realizable value. Suppose, sir, they are net realizable value means right now if I could sell them in the market, how much price I am going to get. So see, generally agriculture products, forest products, these are all mineral products. So there is a separate industrial standard how they will be measured. So if you are measuring them at their NRV, don't apply this standard. Suppose if you are not applying NRV, if you are not valuing them NRV, then normally you can apply, because the exception is what? To the extent they are valued at NRV, this standard is not applicable. And suppose if I am a commodity broker, so suppose if I am a trader, so I need to value them at a fair value minus cost of sale. Suppose commodity traders, commodity brokers will be there. So this iron, aluminum, petrol, diesel, commodity traders will be there in the market. Now for this commodity traders also, this standard is not applicable, because they have to make their inventory valuation at fair market value, fair value minus cost of the sale, fair value minus cost of the sale. See, commodity broker, trader who measure their inventories at fair value less cost to sale. So this is fair value, fair value minus cost of sale. So I think you understood the scope. So you have to remember it. This standard is not applicable to financial instruments, biological assets relating to agriculture activity plus agriculture produce. And AS2 measurement is not applicable to agriculture, forest products, minerals and mineral products, to the extent they are valued at NRV. Suppose if they are not valued at NRV, this standard is very much applicable. And commodities brokers. So commodity broker or trader, they generally value the inventory at fair value minus cost of sales. They will not measure at NRV, cost or NRV, whichever is lower. So therefore this is the scope of the standard. So we completed the inventory definition, objective, scope. Now measurement of inventories. Sir, how to measure the inventories? See, if you read Ind AS 2, they clearly said, take the cost, take the NRV, whichever is lower is the value of inventory at the end of the year. So cost or NRV, whichever is lower, that is how we need to measure it. Finished goods, see, cost or NR, whichever is lower. Now listen to me, very interesting discussion I will make. See, generally I told you finished goods, work in progress, raw material, three types of inventories. Now for finished goods and work in progress, this principle holds good, that is cost or NRV, whichever is lower. That means the cost will compared with its net realizable value, whichever is lower, that will be the value. But it will not hold good in case of raw material, because raw material is not held for sale in the ordinary course of the business. You purchase raw material for use in the production, not held for sale. Therefore you cannot compare the cost of the raw material with its NRV. So that's why cost or NRV, whichever is lower, is not applicable in case of raw material. Sir, then how to value the raw material? See, simple. Raw material you held it for use in the production, right? It is not meant for sale. Therefore, cost or NRV, whichever is lower, principle will not hold good. Therefore, remember always the basic principle is raw material is always valued at cost. What pa? Raw material is always valued at cost. Raw material is always valued at its cost. But there is one exception. What is that exception? Suppose you are using this raw material in particular finished product, right? Now if the finished good is sold below the cost. Suppose you are using this raw material for a particular finished good. Now the finished good is sold, the sale value, NRV is less than cost. That means the finished good is valued at NRV, because cost or NRV, whichever is lower. If the NRV is lower than the cost, you need to value them at NRV only, na? So cost or NRV, whichever is lower. Now if the finished good itself is valued below the cost, then raw material should also be brought from, we have to check whether this, see, because when the finished goods demand, if the finished goods value fall down, obviously raw material value will also fall down. So therefore, whenever the finished goods NRV, finished goods are valued at its NRV, that indicates that it is less than cost, because the formula is cost or NRV, whichever is lower. So if the NRV is lower than the cost, we will value it NRV, na? So the moment you see the finished goods NRV is less than cost, then raw material should be brought to its replacement cost. What is replacement cost? Right now, if I want to purchase this raw material from the market, at what price I will acquire? That is called replacement cost. So therefore, whenever always raw material is valued at cost. This is the first principle. Second, but see whether the finished good is valued at cost or NRV now. Suppose if the finished good is valued at cost or NRV, whichever is lower. Suppose if cost is less than NRV, no problem, because NRV is more than cost. That means there is a demand for this finished good in the market, and at least I can able to sell it beyond cost. That is no problem. But the moment you see the finished good is valued at NRV, that means the sale value, the NRV is less than cost, then you should brought the raw material to its replacement cost, provided the replacement cost is less than cost. See, for example, see here, I have given an example also. See, suppose there is a finished good. Now the cost of the finished good is 100 rupees here, or its NRV is 110. Tell me. So finished good 100 rupees cost, net realizable value 110. If I sell it in the market, at what value you will value? 100 rupees cost or NRV, whichever is lower. That is nothing but the cost, right? So it is a better position. Why it is a better position? Because NRV is more than cost here. Better na? Now in such a situation, raw material is valued at cost only. Let it be at cost. But the moment you see cost 100 rupees, NRV 90, finished good cost 100, NRV 90. That means you will value at 90. That means NRV, right? NRV. Now the moment you see the finished goods in which this raw material is using is valued below cost, that is NRV, then raw material should be brought from cost to replacement cost. Suppose the cost of each raw material is 10, now 8 rupees replacement cost. Now it should be valued at 8. So what is the measurement of inventories? Cost or NRV, whichever is lower. This principle holds good for finished goods and work in progress, but not for raw material, because raw material is not meant for sale. Then raw material is always valued at cost, but the finished good in which this raw material is valued at NRV. Then raw material should be brought to its replacement cost, provided the replacement cost is less than cost. Suppose for example, sometimes what he will do is, he will give you replacement cost 11 rupees and he will give you the finished good is valued at NRV. NRV means when we value at NRV, when NRV is less than cost. I told you when NRV is less than cost, you should value the raw material at a replacement cost. So you will take 11, wrong. Always remember this replacement cost should be less than the cost. Then only you should brought to replacement cost. Suppose for example, if the replacement cost is more than cost, you should not increase the inventory value, because on one hand the finished good in which this raw material is used, the demand of this raw material, the demand of the finished good is falling down now. So because the NRV is less than cost. Sir, are you all following what I am saying, sir? Very, very important, sir. Most of the students are confusing here. Always remember, sir, raw material valuation depends upon the finished goods valuation. You cannot apply cost or NRV, whichever is lower. That principle you cannot apply to raw material, because raw material is not meant for sale. It is used in some other good, finished good, right? So therefore, the finished goods valuation will affect the raw material valuation. If the finished goods are valued at cost, no problem, raw material will be valued at cost. If the finished good is valued at NRV, then raw material should be brought to its replacement cost, provided this replacement cost is less than the cost. That's it. So this is how you measure the inventories. So what we understood, cost or NRV, whichever is lower. So cost or NRV, whichever is lower. Now how to determine the cost, sir? How to determine the cost? See, cost or NRV, whichever is lower, right? Now come to the cost of inventories. How to determine the cost of inventories? Okay, simple, sir. Determination of cost is quite simple. First take cost of purchase, sir. Cost of purchase. Because see, for production you purchase raw material. So raw material purchase, first of all it will be brought to the company, right? Brought to the factory. So take purchase price. For that, whatever the taxes you paid, add, of course, non-refundable taxes. If there are refundable taxes, exclude them. Okay. Suppose, for example, any tax you paid, but government is giving you refund. Then in such a situation, the tax should not be part of the cost of purchase, right? Only non-refundable taxes you have to take. Non-refundable taxes. And discount. Suppose when I purchasing any raw material, the supplier may give some discount to me. So that discount I have to reduce. And then any freight. So add insurance, add, because to bring this raw material to the factory, so I have to incur some freight cost, transportation cost, insurance. So any local taxes I paid, all those things. Then you will get what? Cost of purchase. So in the process of determining the cost of inventories, the first thing is cost of purchase. Next, cost of conversion. Next, other cost. See, what is this other, cost of conversion? Simple. Sir, to convert the raw material into finished goods. See, the conversion cost is nothing but the cost which we incur to convert the, finished goods. To produce finished good, what cost we have incurred? Raw material we purchased, sir. Next, labor, sir, labor cost. Then overhead cost. You know, in costing, material, labor, overheads. So these three things we are saying. First, cost of purchase means purchase material cost. Then cost of conversion. Cost of conversion means labor cost, overhead cost. No, labor cost we directly take. Overheads are two types: variable overheads, fixed overheads, right? Now variable overheads, what you do? You can directly take, now see, variable overheads relating to the production, directly linked with the production. So how many units you are producing into variable cost per unit. What about the fixed overheads? This is very, very important. Listen to me carefully. Because see, fixed overheads is irrespective of your production. So number of units you produce, the fixed overheads constantly same now. Now these fixed overheads we need to include in the value of inventory. How much value you will include? So will you include entire amount of the fixed overheads? See, the fixed overheads will be included in the inventory. I will. Here is one table. Yes, see here. Not this one. This we completed. This one. See here. For labor, direct labor cost will take. Cost of purchase also we have taken. Now factory overheads, you see, fixed, variable. Variable overheads will be allocated to inventory cost based on actual production. How many units you produced into cost per variable cost per unit. What about fixed overheads? At a normal capacity, at actual capacity. Either at normal capacity or actual capacity. When normal capacity, simple. When actual production is almost equal to or lower than the normal capacity. When the actual production is higher than the normal capacity, then at actual production. So can I say that actual capacity or normal capacity, whichever is higher? This is the formula. So remember now, this is very, very important. Please carefully follow. Okay, most of the student doesn't know the logic behind it. I will explain. Always, Nana, see, first of all, what we are learning how to measure the value of inventories. What Ind AS 2 says, cost or NR, whichever is lower. Now we are learning how to determine the cost. Tell me, cost having three components: purchase, conversion, other cost. Now in that purchase cost we learned. Next, conversion cost, labor, direct labor we will take directly. Next, overheads. Now we are learning overheads. Now overhead cost will be included in the inventory value. Now these overheads are basically divided into two types: variable, fixed. Variable overheads are allocated based on actual production. Always allocate based on actual production. How many units you produced, based on that you allocate. But fixed overheads always allocate actual or normal, whichever is higher, not lower. Whichever is higher, you take actual production or normal production, or actual capacity or normal capacity. Both are same only. Actual production or normal production. Actual capacity, normal capacity, whichever is higher. Okay, sir, what is this normal capacity? See, with the given installed capacity, how many units you can able to produce? That is normal capacity. For example, with the given plant and machinery, given installed capacity of your organization, you can able to produce 1 lakh units. Now can I say this is normal capacity, but actually you produce 90,000 units. This is called actual capacity. So what is the difference between actual capacity and normal capacity? Normal capacity is what, see, with the given facilities, how much you can produce, but what actually you produced. So you can able to produce 1 lakh, but you produce only 90. Now standard says whenever you are allocating fixed overheads, okay, whichever is higher you take. That means based on 1 lakh units you allocate. Okay, based on 1 lakh units you allocate. See, I have given one example also. See here what happens in this example. Suppose there is a entity. See, what is the normal capacity of this entity, sir? 1 lakh units. You see here. Normal capacity 1 lakh units. Okay. Actual capacity 90,000 units. Now suppose your fixed overheads is 10 lakh rupees. Now tell me what is the allocation basis. How much of this 10 lakhs will be allocated to the inventory cost? Simple. Fixed overheads divided by actual or normal, whichever is higher. That means 1 lakh. So 10 lakhs divided by 1 lakh, that is 10 rupees. 10 rupees per unit. Suppose you produce 90,000 units na. So 90,000 into 10. 90,000 into 10. So how much you allocated? 9 lakhs you allocated. Sir, your fixed overheads is 10 lakhs, sir. But you allocated only 9 lakhs. That means that 9 lakhs is what? Absorbed, allocated fixed overheads in the production cost, in the inventory. Unallocated overheads cost to 1 lakh fixed overhead. What we need to do? We need to treat that unallocated fixed overhead cost as a period cost. So normal expenses which we debit to P&L account. What is your fixed overheads? 10 lakh rupees. Don't add this 10 lakhs directly to the production inventory cost. Out of this 10 lakh, find out the absorption rate. Absorption rate means 10 lakhs divided by actual or normal, whichever is higher, 1 lakh. So that means 10 rupees per unit you need to absorb. That means if I produce 90,000 units, each unit I need to allocate 10 rupees. How much I am absorbing? 9 lakhs. Sir, what is your fixed overheads? 10 lakhs. But you are absorbing only 9 lakhs to the inventory cost. What about this unallocated 1 lakh? That will be your period cost debited to P&L account. Now see, sir, why? See, when you said for variable overheads, actual production. But for fixed overheads, you are saying actual or normal, whichever is higher. Why, sir? Whichever is lower, why can't? Suppose, for example, here normal capacity 1 lakh, actual capacity 90. Suppose whichever is lower. If I take 90, what happens? Now 90,000. See here, 10 lakhs divided by 90. If I allocate based on actual capacity, my absorption capacity, my unit per unit allocated cost how much? 11.11 into how many units I produced? 90,000. That means total 10 lakhs is absorbed into the production. That means your inventory value will increase na. Instead of allocating 9 lakhs, if I allocate 10 lakhs, 1 lakhs extra, it is included. Right? Now the point here to understand is, see, actually I am underperforming. If my normal capacity is 1 lakh, but I produce only 90,000 units, that means there is a abnormal loss. There is a, what we can say, poor production planning, or maybe because of unskilled labor, or because of the excessive wastage of the time. So instead of 1 lakh units, we produce 90,000. That means there is an inefficiency in your organization. But you want to include that inefficiency as a part of inventory. That means you want to treat this inefficiency as a part of your asset. That is not correct. That's why the standard is saying whenever you are allocating fixed overheads, actual or normal, whichever is higher you take. Therefore, you will be allocated only to that extent. So only to that extent which is actually necessary. Okay. So therefore, here what we need to do is this 10 lakhs divided by 1 lakh you take. So 10 rupees. So 10 lakhs divided by 90,000 if I take, it will be 11.11. That means I am allocating everything, which is not correct. So I think you understood why the standard says whichever is higher rather than whichever is lower. Because if I take whichever is lower, then my inefficiency is included as a part of inventory cost, which is not the intention of the standard. Can your weakness be your strength, sir? No. See, actually you have produced 90,000 units, but you can produce 1 lakh units. That means 10,000 units is because of your poor planning. So poor planning you have wasted. Now you want to include that 10,000 units appropriate, proportionate fixed overhead cost also as a part of this. It is not correct now. So that's it. So therefore, so always cost of conversion, tell me, remember in exam they may ask a question. Whenever you see overheads, see inventory cost, purchase cost, labor cost, overhead cost. Fixed overheads, variable overheads. So simple, variable overheads based on actual capacity. Fixed overheads, actual or normal, whichever is higher. I told you the reason also. Okay. Quickly I will move forward. And remember, this is a marathon. So most important things I will spend some time. I can spend some time, but I can't explain it in a detailed manner now. Especially even if you spend too much time on one thing now, I think it is not suggestible. Just 10 days or 1 week before the exams. Okay. My recommendation to everybody is to go through the concept quickly. Don't waste much time on the concept, reading again and again, spending too much time on the one concept. For example, India is 2. So approximately it will take 40 to 45 minutes. You listen to this 40-45 minutes 1 or 2 times. That's it. And if possible, open the CMA material and solve the questions. More than sufficient. Okay. Next, any other cost? Sir, all other cost which is necessary to bring the inventory to its location, so can also be included. See here. So any other cost included, other costs are included in the cost of inventories to the extent they are incurred in bringing the inventories to their present location and condition. So cost of designing the product, amortization of intangible for ascertaining the inventory cost, that is patents, right of production or copyrights for a publisher, should be taken as a part of inventory cost. So that means what basically they want to trying to tell you is that, so there are certain cost here, other cost. What is other cost? Any other cost which is incurred to bring the inventory to its present location and condition as it required for it. So whatever the cost, for example, designing cost. For example, in order to manufacture a particular product, first you should design it now, the designing cost. So it is also part of inventory cost. Next, for example, if you are using any tangible fixed asset, intangible fixed asset in the production of a particular inventory, that the amortization, the depreciation will also be included as a part of inventory cost. And similarly, interest cost can also be included. Provided the inventory is what? Provided the inventory is a qualifying asset. Now see, which cost we should not include it. This is very, very important. Exclusions from the cost of inventories. See, there are certain costs we should not include. For example, interest and other borrowing cost. If it is not relating to bringing the inventories to their present location and condition. So if you are incurring any interest and other borrowing cost not relating to bringing the inventories to their present location and condition, don't include it as a part of cost of inventories. But I told you, I think if you listen to my financial accounting classes or financial accounting marathon in India, normal accounting standard 16, there I told you, if inventory is a qualifying asset, then we can include inventory cost as a part of cost of inventories. But generally, any interest and other borrowing cost, so if it is not relating to bringing the inventories to their present location and condition, don't include it. Okay, but however, if the inventory has taken substantial period of time to getting ready for intended sale, as per Ind AS 23, that is nothing but the borrowing cost. If it is a qualifying asset, then inventory included. For example, inventory, wine is a qualifying asset because it takes substantial period of time to get ready for intended use or sale. Then see, when you are manufacturing a qualifying asset which takes substantial period of time to get ready for its intended use or sale, then inventory and other interest and other borrowing costs, you can include it. But for normal inventory, interest and other costs should not be included. So this is the first exclusion from the cost of inventories. Next, second, any abnormal wastage, materials, labor, other production cost, we should not include. The best example we have seen now, the fixed production overheads. So actual or normal, whichever is higher we have taken, not whichever is lower. Suppose if you take whichever is lower, what happens is your inefficiency, your abnormal loss, abnormal wastage will be included as a part of cost of inventory. So that is not the intention of Ind AS 2. So therefore, any abnormal wastage of material, labor, other production costs, don't include it. And also any storage cost, unless those costs are not necessary in the production process prior to further production stage. Now storage cost, suppose see, I will keep my inventory in the godown, whether that storage cost is also included? No, generally no, because see, once the production is over, till that point of time only we will add. Once the production is over, suppose if I keep the material in the godown, is it anyway necessary to bring the inventory to their present location and condition? No, therefore it should not be included. But of course, if the storage is necessary for further processing, then it can be included. And administration overheads, Generally, admin overhead should not be included as a part of cost of inventories because that is no way connected with bringing the inventories to their present location and condition. And selling and distribution cost is also not to be included. So tell me, what are the exclusions and inclusions? First of all, what we are learning? Measurement of inventories. How to measure the inventories? Cost or NR, whichever is lower. How to determine the cost? Cost of purchase, cost of conversion, other cost. Cost of purchase, purchase price, add all taxes, refundable, non-refundable taxes, less discount, add freight, all these things. Then cost of conversion, direct labor plus overheads. Overheads can be two types: variable, fixed. Variable overheads always actual production. Fixed overheads, actual or normal, whichever is higher. Then other cost, any other cost to bring the inventory to their present location and condition, like for example design cost, any depreciation, amortization of the assets which we use in the production. And what are the costs we should be excluded from the cost of inventories? Interest and other borrowing costs we should not include if they are not directly relating to bring the inventories to their present location and condition. Suppose if the inventory is a qualifying asset, then interest cost directly relating to that can be included as a part of borrowing, can be included as a part of cost of inventories. Next, abnormal wastage of material, labor, other production cost we should not take. Any storage cost, unless it is necessary in the production process prior to further production stage, then we should not include it. And next, any abnormal administration overheads, don't include it. Any selling and distribution overheads, please don't include it as a part of cost of inventories. So this is cost of inventories, sir. Very, very simple, sir. Now, sir, you said what is the valuation principle? Cost or NRV, which was there. Now, how to determine the NRV? We discussed how to determine the cost. Now, NRV, see, simple. Tell me, cost or NRV is applicable for what? Finished goods, work in progress, not for raw material, right? So, therefore, this NRV is applicable only for finished goods and work in progress. Now, suppose, how to find out the NRV of the finished goods? Simple. Take the estimated selling price of the finished goods. So, right now, if I sell this finished good in the market, how much I am going to get? Minus what is the cost of sale. To sell these finished goods, how much cost I am going to incur? Minus it. Then you will get net realizable value. Similarly, work in progress. So, see, important, sir. How to determine the NRV of work in progress? See, work in progress means a semi-finished good. Is semi-finished good will have direct selling price? No. That's why what we need to take is, if this semi-finished good, work in progress, will convert into finished good, and if it is sold in the market, how much I am going to get? So take the estimated selling price of the finished goods minus two things. One is, what is the estimated cost of conversion? To convert this work in progress into finished good, how much cost I am going to incur? And also, what is the estimated cost of sale to sell this finished good in the market? Then you will get the NRV. So what is the difference between NRV of a finished good, NRV of a work in progress? NRV of a finished good means, see, directly the selling price is available. So sale price minus cost of sale. But if you are taking the NRV of a work in progress, direct sale price is not available. Therefore, take the sale price of the finished good. From that, you reduce two things. One is cost of conversion and another one is cost of sales. I think you understood this. Okay. Next. And sir, two more important things here, sir. First is, so cost of inventories of a service provider. Suppose if I am a service provider, how my inventories will be measured? So generally, sir, these service providers, their inventory will be measured at a cost. See here, to the extent the service provider have inventories, they measure them at their cost of their production. These costs primarily consisting of what we have discussed: labor and other cost of personnel directly engaged in providing the service, including supervisory personnel, attributable overheads. See, if I am a service provider, it is not like I have a factory. In that factory, I am incurring some overheads. Not like that. Suppose if I am a service provider, what overheads are there for me? I have to take those overheads, variable overheads, fixed overheads. So like that, I have to take. See here, attributable overheads, labor and other costs relating to sale and administrative persons are not included but are recognized as expense in the period in which they are incurred. Okay, the cost of inventories of a service provider does not include profit margins or non-attributable overheads that are often factored into prices charged by service providers. See, that means generally when you are valuing the inventories, what they will do is, if I am a service provider, I will not include any profit margins or any non-attributable overheads. So these overheads which should not be attributed to the anything, so generally they should not be included. Okay, not that much important, leave it. Next, suppose for example, what is the cost of agricultural produce harvested from biological assets? So I told you there is a separate standard. Now according to that standard they will measure it. Okay, In accordance with Ind AS 1, Ind AS 41, agriculture inventories comprising agriculture produce that an entity has harvested from its biological assets are measured on initial recognition at their fair values, less cost to sell at the point of harvest. So suppose if you are producing any agriculture produce from the biological assets, so you will value them at fair value less cost of sale. Okay. Now next sir, so we discussed the inventory definition, objective scope, measurement of inventories, cost, NRV we completed. See, in case of joint production byproducts, suppose sir, through common production process, if you are able to generate 2 or more products and each one is having a significant sale value, we call them as joint products. Suppose for example, see, there is a common production process, and at one point of time, out of this common production process, 2 products are generated, A and B. And when we call them as joint products, when each product is significant, having its own market value. Suppose through common production process, 2 products are generated, A and B. But out of these 2 products, one product is having significant market value, another product does not have any significant value. Then that product is called byproduct. Now remember always, in case of a joint products, what we do is the common production cost will be allocated between the joint products. On what basis? Either on some rational basis, like either based on the sale value of the joint products, or once the joint products are developed or generated, we may do the further processing. Now after further processing, they may sell it in the market. Now what is the sale value of those products? On that basis we can apportion this joint production cost. See, simple here. Through one common production, you are able to generate 2 or more products now. So therefore the joint cost, whatever you incurred in the production process, will be allocated between the joint products. On what basis? Either based on the sale value, or based on the further sale value, or any other rational basis which you consider necessary. Correct. On that basis you can allocate. Now sometimes what happens now, through common production process you generate 2 or more products, but out of that one product may not have significant value. We call them as byproduct. Now, in case of a byproduct, standard says don't treat it as a normal product. So, the byproduct you will sell them in the market as a scrap value, as a scrap. You will get some amount, right? That amount, what you need to do is you need to reduce from the cost, total cost, and the remaining cost will be the cost of the main product. Okay, this is how you need to value the joint products and byproducts. Okay. Now, next one, sir. Cost formulas. See, in order to measure the inventory, sir, there are certain formulas we will use. So what formulas generally we will use? The formulas, cost formulas. Okay. Now suppose for example FIFO method, weighted average method we will use. So here the cost of inventories of items that are not ordinarily interchangeable, and the goods and services produced and segregated for specific projects should be assigned by specific identification of their individual cost. For example, what they are telling is, if you are producing products for a specific project, for example, you got a contract from Indian Railways. Now you manufactured some items for their specific purpose. Now in that situation, you need to follow specific identification of cost method. That means for this exclusive manufacturing, for this contract, how much cost I incurred. So you have to decide separately. You should not include them with the normal other items. Okay. But in all other cases, generally, suppose for example, in the factory we will make manufacturing. So in all other cases, we follow either FIFO method or weighted average method. So whichever method gives fairest possible approximation to the cost incurred, you follow that method. Okay. Now, apart from that, they have given some other techniques of measurement of cost. What is that? See, instead of actual standard costing method can also be followed. Okay. But when you are determining, see, standard cost method, we need to determine the standard, average cost of the product, standard cost of the product. So, suppose the company generally, to measure the inventories, cost or NRV, they are following. Now, to determine the cost, see, these are the techniques for measurement of cost. To determine the cost, we can follow standard cost method. So, how to determine the standard cost? By considering the normal levels of material consumption, labor, capacity utilization you consider, and you determine one standard cost. That standard cost is the cost of inventory. And suppose if you are in retail business, the standard is suggesting one more method, retail business, like DMart. For example, when large number of rapidly changing items are traded, you are dealing in large numbers which are rapidly changing every day. Now the actual cost of items may be difficult to determine. Then suppose for example, if you are dealing in large number of rapidly changing items, then determining the cost is very difficult. That's why they said you follow retail price method, retail method. And see, most important thing is the units dealt by the retailer, however, usually sold for a similar gross margin. The margin should be more or less the same. Okay. Now in this method, how to determine the value of inventory? Simple. Take the cost of inventory which is unsold minus margin. So cost of inventory is determined by reducing the sale value of the unsold stock you take. From that you reduce the margin. Okay. So this is the method we can follow. Very simple method, sir. So sir, what you are teaching is cost formulas. There are certain formulas which is there in the India to determine the cost. So generally FIFO method, weighted average method, like that there are certain formulas. Cost or NR, whichever is lower, to determine the cost. And there are some techniques also for measurement of cost. Standard cost method, retail price method. See, out of this, retail price method is important. See, retail price method means when you are dealing in large number of rapidly changing items and which is having a similar margin, you follow retail price method. Now in retail price method, what happens is first you take the sale value of the unsold items minus margin you reduce, gross margin. Then you will get the cost of inventory. Okay, cost of inventory. You have some questions also. Please solve these questions in study material. So immediately after listening to this, you solve these questions. You can able to solve all these questions. Totally there are 11 to 12 questions are there. So you solve them. Okay. Now NRV I discussed. And then finally disclosures. So relating to AS2 inventories, what points we need to disclose, everything will be given here. Illustration 6 is very important. I mean, that interest point I told, generally interest will not be included as a part of cost of inventories relating to that point. Okay, so that's it, sir. I think this one, sir. This question you see, X Limited presented the following particulars on 31st March 2021 on the total cost of product. Cost of materials 12 each, cost per unit 50, manufacturing inputs 30, total cost 80, profit 20, selling price 100. Okay. On 31st March 2021, selling price has gone down suddenly from 100 to 70. See, actually, this is the finished good, right? What is the selling price? 100. And what is the cost? 80. So cost or NR, whichever is lower, means 80. But see, suppose the selling price is now 70. 70 or 80, whichever is lower, means 70. That means the finished goods are valued at NRV. That means NRV is less than cost. I told you, when NRV of the finished good is less than cost, then raw material is valued at replacement cost. Because see, when the finished good sale value is less than cost, that means there is no demand in the market, then raw material values always should be valued at cost, I told you. But the moment the raw material, the finished good in which this raw material is used, is valued itself beyond below cost, then raw material should be checked. Now here see, what is the cost of raw material? The price of the raw material has also gone down to 8 each. That means this is replacement cost. X Limited in its stock 6,000 units of material which was bought as per the rate on the same date. Compute the value of stock on 31st March 2021. How to compute the value? Tell me. See, first two things here. One is finished good. What is the finished good? Finished good valuation point. Cost or NR which is lower. What is the cost? 80. NRV 70 because 100 to 70. Now whichever is lower, that means 70. So finished good is done. Now come to raw material. Now you tell me, raw material valuation depends upon finished goods valuation. Now the finished goods is valued at NRV. The moment the net realizable value, the sale value is less than the cost, the demand for the finished good is a little bit drastically reduced. Then raw material, should it be valued at cost or replacement cost? Replacement cost. What is the replacement cost? 8. Actually, what is the cost of raw material? 12. Suppose if the finished good is valued at cost, when we will value at cost, if the cost is less than NRV, that means NRV is more than cost, no problem. But the NRV is less than the cost, then raw material should be valued at its replacement cost. What is the replacement cost here? 8. So therefore it is valued at 8. So 8 rupees. So here 70 into how many units, sir? 6,000 units. And this is 6,000 units. So therefore 6,000 into 70, 4,20,000. This is finished goods value. And what about raw material? 8. 8 into 6,000. It will be 48,000. See the questions please. Very, very simple. Okay. So this is Ind AS 2. So I explained the important items. So remaining things, disclosures, all that not important. The main text is how to value them and scope. So I explained it. Thank you. So the next standard for discussion is Ind AS 10, sir, which is about events occurring after reporting period. Very simple standard, sir. Listen to me carefully. So see, I will explain you why this standard came, what is the main object of this standard. Suppose for example, the financial year 24-25, sir. Now, you know this 1/4/2024 to 31st March 2025. So this year will be completed. Now, we know that once the year is complete, we need to prepare the financial statements for that financial year, right? But in order to, prepare the financial statements, first of all, the books of accounts must be ready. Practically, by 31st March, it is impossible to update everything to prepare the books of accounts. So therefore, if you see, once the year gets completed, the companies will first complete their books of accounts, updating everything, writing all adjustment entries, because the March month, a lot of adjustments are required to be made. A lot of adjustment entries are to be made in the books of accounts. Okay. So therefore, the year is completed, books must be ready. It will take some time. For example, 3 months, 4 months. Suppose 3 months time it has taken. The books are ready. Now, once the books are ready, the financial statements will be prepared now. Once the financial statements are prepared, then it will be approved by the board of directors, right? So financial statements approved by BOD, board of directors. After books are ready, financial statements will be prepared, and after that the board of directors will approve the financial statements. Suppose 30th June 2025, the financial statements are approved by the board of directors. Now see, the year end 31st March 2025 and 30th June 2025, that is the year, that is the date on which the financial statements are approved by board of directors. Now there is a gap of how much, sir? 3 months, right? What is this gap? The gap between the year end and the date on which the financial statements are approved by the board of directors. In case of a company, other than company, any other governing body, whatever be the name is not the matter here. So when the financial statements are approved by the corresponding authority, now between this gap, whatever the events happened, see, the events happen between this gap, whether the effect of those events will be considered in the financial statements or not. Because see, already 31st March is over, but financial statements are not yet prepared. So we have a time till the books are ready. And once the books are ready, we need to prepare financial statements and they will be approved. So they are saying that approval date, balance sheet date, approval date. So in this gap, any event happened, whether the effect of that event we will include in the current year financial statements, will it be considered? So it is fair enough. See, for example, 31st March year completed. Suppose January month there is a fire happened in the premises and the stock is destroyed. Whether the loss will be considered or not? Because financial statements not yet prepared. Now that means by the time you are preparing financial statements, you know that there is a fire happened and because of that there is a loss. Whether that loss will be considered or not? Suppose for example, after 31st March, the debtors may become insolvent. Whether we need to create a provision or not? So therefore, see, the problem here is there is a periodicity concept which says, see, you are preparing financial statements for 24-25. That means within this 12 months, whatever the transactions and whatever the events happen, financial events, you record everything in the financial statements. The effect of that must be considered in the financial statements. But whether after this 12 months, whatever happened in the business, but before preparation and approval of financial statements, whether the effect of that event will be considered in the financial statements of the current year. Because see, actually speaking, once 31st March 2025 is over, whatever the event happened, that belongs to next year. So it should part of the next year financial statements. But here the current year financial statements are not yet ready. So by the time you are preparing the financial statements and approving it by the board of directors, you know that this event happened in the business. But this event has not happened within this 12 months, but this has happened after 12 months, but before approval. Now, whether the effect of this event will be considered or not, that is what this standard is all about. That's why look at the name of the standard, events after the reporting period. See, so many students have not understood. They are not reading the standard name also correctly. Not only, because here have they said transactions or events, not transactions. See, transactions after the reporting date obviously will belongs to next year only, but they are talking about only events, not transactions. So please read the name of the standard properly. So many students and faculties also have not understood this standard perfectly. So events occurring after the reporting date. So what is the event which occurred after the reporting date but before approval? So this is the cutoff date. So first of all, what is events occurring after balance sheet date? Those events which happened between this gap, that is balance sheet date and approval date. Now standard says, see, okay, there are certain events happened between this gap. Whether the effect of these events will be considered or not. Now standard says these events are divided into two types: adjusting, non-adjusting event. Adjusting events, non-adjusting event. Suppose if it is an adjusting event, consider the effect. Non-adjusting event, don't consider the effect. As simple as that. So therefore, now you need to understand, sir, when an event which occurred after the balance sheet date before approval, within that gap, will become an adjusting event. See, first of all, what is an adjusting event? Standard says any event which provide further evidence. Observe the words carefully. Observe my words. Further evidence of conditions that existed at balance sheet date. See, further evidence. What is further? Additional. What is not there with us? We have some information, some evidence, but further evidence of what? Of conditions, situations that existed on which date? Balance sheet date. Very, very important. So, adjusting event is an event that provides further evidence of what? Of conditions that existed on balance sheet date. Whatever the situations, conditions which is prevailing on the balance sheet date, relating to those conditions, the event subsequently happened is providing additional evidence. Now that is called adjusting event. Sir, that means we need to connect the dots. See, for example, this is 31st March. 31st March, there is a situation, there is a condition prevailing, and subsequently an event happened in the organization. Now this subsequent event is providing additional evidence in respect of the conditions that existed on balance sheet. So connection of dots. We can connect the dots by looking backwards. Right? So therefore, this is 31st March. Now this is, for example, 10th April after balance sheet date. Now, whether the subsequent event is providing additional evidence relating to the conditions existed on balance sheet date. Yes, sir, it is providing further evidence in respect of the condition situations that is prevailing on the balance sheet date. Adjusting event. Consider the effect on the financial statements. Sir, no, sir, it is no way connected with 31st March. It is not providing any additional evidence in respect of the conditions that existed on balance sheet date. Therefore, it's a non-adjusting event. Don't consider it. As simple as that. So, therefore, what is adjusting event? An event which happened that gap, within that gap, and it is providing additional evidence. The additional evidence means new evidence, further evidence which is not there with us in respect of the conditions already there on the balance sheet date. Suppose, sir, on balance sheet date there is no condition, there is no situation. That means a completely new event happened. Then it is not an adjusting event, it will become a non-adjusting event. So, on the balance sheet date, there must be a situation, there must be a condition, and in respect of that situation, we have some information or no information. But this subsequent event is providing further information, additional information, new information, which enable us to take some one decision. Make one decision. That's why this is called adjusting event. I will tell you best example. For example, you think about it. Suppose 31st March, we came to know that one of our debtor's premises, there is a fire. So we hear that the fire magnitude is so huge, there is a huge loss of assets. Okay, but we don't know anything. How much loss in amounts, we don't know about it, but we heard it that there is a fire happened in the debtor premises and there is a loss, huge loss. Now that means on balance sheet date, what is the condition situation prevailing? There is a fire happened. We know that. And there is a huge loss. Okay. Next, subsequently, after 31st March, for example, on 10th April, this debtor has filed an insolvency petition, IP. Insolvency petition he filed. Now, court declared that, so every 1 rupee, he will give you only 25 paise. 25 paise. That means, see, on balance sheet date, there is a situation, condition prevailing that there is a fire in the debtor premises. But we don't know how much will be our loss, how much amount we are going to recover it from him, how much amount of the provision we need to create. We don't have any evidence, we don't have any information, full-fledged information. But subsequent event which provides further evidence of conditions that existed on balance sheet date. Therefore, this is a classic case of adjusting event, debtor becoming insolvent. See, on 31st March, we know already fire happened. Sir, suppose for example, by 31st March, fire not happened, sir. Fire happened after 31st March. Then it will become a non-adjusting event, na? Because to become a adjusting event, the conditions must be existed on balance sheet date. Look at the definition which is there in the Ind AS 10. Provide further evidence of conditions that existed at balance sheet date. For example, a fire happened on 10th April. Tell me, fire happened in our factory. Is it an adjusting or non-adjusting event? Non-adjusting event, na? Because it does not have any conditions existed on balance sheet date. So on 31st March, can you say definitely on 10th April fire will come? Is there any situation existing on the balance sheet date? No. Therefore, it's a non-adjusting event. So to say any event which subsequently happened is an adjusting event, definitely should have a connection with 31st March. So therefore, you can able to establish a connection. If you are not able to establish a connection between 31st March and the subsequent event, it's a non-adjusting event. You should able to establish connection. How? This subsequent event must provide further evidence of conditions that existed on balance sheet date. I have given some examples here. See, 31st March year completed, 10th April fire occurred, stock destroyed, 10 lakh rupees. Whether this loss will be considered? No, because it's a non-adjusting event. Sir, you can argue, sir, you said after 31st March fire happened, our assets destroyed, 10 lakhs worth of destroyed. Can you not consider this 10 lakhs as your loss? No. Why? Because it is not an adjusting event, na? In order to becoming an adjusting event, this subsequent event and 31st March, there should be a connection. On whatever the 31st March, the situation, the conditions prevailing, the subsequent event will provide further evidence of the conditions that existed on balance sheet date. But it is no way connected, na? Fire happening is not the situation already prevailing in the organization. It's a completely new event which happened. So it's a non-adjusting event. Now this debtor example I told. So debtor example is what? Debtor becoming insolvent, and by 31st March we know that in his premises there is a fire. So therefore on balance sheet date, there is a situation condition prevailing and subsequent event is providing further evidence of conditions that existed on balance sheet date. So if it is, if it is an adjusting event, what we need to do? We need to adjust the corresponding financial items in the financial statements. Sir, if it is a non-adjusting event, no adjustment in the financial statements. We need to adjust the corresponding financial items of financial statements. Sir, what is non-adjusting event? See, non-adjusting events are those events which provide evidence relating to the conditions or situations which prevails after balance sheet date. Suppose the situations, the conditions which is existed on balance sheet date, relating to those situations and events, the subsequent events is providing further evidence, adjusting event. Suppose there are no situations prevailing on the balance sheet date. That means the event which subsequently happened is no way connected with 31st March. Therefore, it's a non-adjusting event. Okay. Now see, if it is an adjusting event, we need to adjust the corresponding items. Like for example, if it is relating to debtors, we will adjust the debtors. We create a provision. So if it is relating to stock, we will adjust the stock. If it is an adjusting event, we will definitely make the adjustment of the corresponding items in the current year. Non-adjusting event, ignore it. But see, standard says, Ind AS 10 says, if it is a non-adjusting event, you need to disclose in the board of directors report if required. Board of directors report, remember, it is not the financial statement. It is in the board of directors report. Now there are certain exceptions, sir. What are the exceptions here? See, exceptions to accounting Ind AS 10. See, any event affecting going concern assumption, important, listen. Sir, any event which is affecting the going concern assumption. See, generally when we prepare financial statements, we will assume that the organization will continue for foreseeable future. That means going concern assumption. Neither have the intention nor have the necessity to curtail its operations. Based on that, we will prepare financial statements, right? Suppose, for example, a subsequent event happened which is affecting our going concern assumption. For example, a fire happened. The magnitude of the fire is so huge that it is beyond our reach to recover it from it. So it is not possible to recover from it. That means the company going concern assumption is affected. Na? For example, after 31st March, before approval of the financial statements, a fire happened in the premises. Now, because of the fire, so there is a huge loss. So that loss is beyond our reach. So we can't able to recover it from it. Then in such a situation, definitely our going concern is affected. Na? See, the moment the going concern assumption is affected, standard says you have to consider the effect and prepare the financial statements. So as if there is no going concern. That means you have to prepare the financial statements based on NRV. So generally when going concern assumption holds good, we prepare financial statements on cost basis. But the moment the going concern assumption is affected, we will shift to NRV basis. That means we will recognize the assets and liabilities based on NRV, net realizable value. So therefore, if the subsequent event is affecting the going concern assumption, then that will be exceptions to AS4. That means you are not required to say adjusting, non-adjusting, directly will consider it. And we will prepare financial statements based on that. Next, any event which is required by law. So, for example, law says you have to deal with the particular item in this manner. You have to deal it. For example, dividend is the best example. So, dividend, they said, any dividend which is declared after 31st March is a non-adjusting item. So, non-adjusting only. When the law said something, you have to follow it because you know that law will prevail over accounting standards. So, if any item is to be presented in a particular manner, so it has to be disclosed in a particular manner as per the law. We need to follow the law. So that's it. This is accounting standard Ind AS 10. So how small standards are? Very, very small. So you have to remember, once again I'm telling, first of all you should learn what is events occurring after balance sheet date. Simple. Any event which occurred between the balance sheet date and the approval of the financial statements by board of directors. Within this gap, within this period is called events occurring after the balance sheet date. Okay, this is the period. Events occurring after the balance sheet date means only in this period we need to consider. Now the events occurring after the balance sheet date are basically two types: adjusting, non-adjusting. Adjusting event means the event which provide further evidence of conditions that existed on the balance sheet date. Non-adjusting event is which is indicative of conditions that existed after the balance sheet date. That means it is no way connected with 31st March. So therefore a completely new event may happen. Or it is not providing any further evidence relating to the conditions existed on balance sheet date, then also it will become a non-adjusting event. So to become an adjusting event, first of all, there must be conditions existed on balance sheet date. Second of all, the subsequent event happened, which will provide further evidence of conditions that existed on balance sheet date. And I told you, if it is an adjusting event, we need to adjust the effect of that event in the financial statements. If it is a non-adjusting event, we should ignore it. Of course, if it is required, we will disclose in the board of directors report. And there are two exceptions to this standard. One is if the event is affecting going concern assumption, then the moment you see it's affecting the going concern assumption, you have to prepare financial statements on NRV basis. No need to see it's a adjusting event or non-adjusting event. It's an exception. And second one is law. When law said something, you have to follow that irrespective whether it is adjusting, non-adjusting event as per accounting standard 4. You have to consider the effect immediately. Okay. Now see the material, the institute material relating to Ind AS 10 events after the reporting period. So objective I told you. So whatever the events which happened between the balance sheet date and the approval date, those events, how to deal with it. So whether the effect will be considered in the financial statements or not, that will be the main objective of this standard. Okay. And scope, it is applicable for the events which happened after the reporting period. And what is the definition of events after the reporting date? Any event which occurred between the reporting period, that is 31st March, and the date when the financial statements are approved by board of directors. Okay. So first of all, that event must fit into that period. Now types of events, two types: adjusting events, non-adjusting events. What is adjusting events? That provide the evidence of conditions existed at the balance sheet date. Adjusting events. What is non-adjusting event? Which are indicative of conditions that arose after the reporting period. That means there is no connection with 31st March. Okay. And how to recognize them? Adjusting events. Adjusting events, the effect must be considered in the financial statements and the corresponding items must be adjusted. So there are certain examples also I have told. Same examples will be there here. Okay. And there are certain questions, very simple questions, simple conceptual application questions. You can see it once. And non-adjusting events after the reporting date, we will not consider the effect of non-adjusting events. If required, we will disclose it in the board of directors report. Suppose for example, an example of non-adjusting event could be decline in the market value of investment between the reporting period and the date when the financial statements are approved for the issue. For example, we made some investments. The investment's market value has been drastically reduced after 31st March. So it's a non-adjusting event because it does not have any conditions existed on 31st March. So the decline in the market value does not normally relate to the condition of the investment at the end of the reporting period, but reflects the circumstances that have arisen subsequently. Therefore, an entity does not adjust the amount of investments in the financial statements. Few other examples also given, like for example, a major business combination or disposal of major business subsidiary after the balance sheet date. Suppose for example, we sold any of our businesses after 31st March. Generally, if it does not have any conditions existed on 31st March, don't consider it as an adjusting event. Or suppose company commencing the implementation of major restructuring activities, or change in the tax rates or tax laws enacted or announced after the balance sheet date, you observe that have a significant effect on the current and deferred tax assets and liabilities, entering into significant commitments, contingent liabilities, so guarantees, which are all happened after 31st March, and commencing a major litigation arising solely out of events that occurred after the balance sheet date. So these are all what non-adjusting event, don't consider them. Now I told you there are two exceptions, right? One is affecting the going concerns. The moment the event which occurred after the balance sheet date is affecting the going concern assumption, then it is an exception. We have to consider it, the effect of that in the financial statements. Okay. And treatment of dividend point also I told. Any dividend declared after 31st March is a non-adjusting event. Okay. So see here, if an entity declares dividend to its equity shareholders after the reporting period, the entity shall not recognize those dividends as a liability. Sir, suppose financial year 24-25. For this financial year, we declared dividend in the year 25-26. See, this year dividend you declared in the current year. Ignore it. Don't consider. Okay. Even though the dividend is relating to the particular year, we should not consider, because there is a specific provision in the Companies Act that any as per Schedule 3, any dividend declared after 31st March is not considered as the current year. Okay. So that's it about this standard. So main text of the standard, main thing about the standard I have discussed. So you remember this much. I think spend half an hour for listening this standard, around 25 minutes it has took me. So listen to this 25 minutes, the standard will be done. Okay. So this is Ind AS 10. So the next standard for discussion, sir, Ind AS 33, which is earning per share. Okay. Sir, earning per share, you know, when we are preparing the P&L account as per Schedule 3, the last item you see, earning per share, basic as well as diluted EPS, we need to disclose on the face of P&L account. So this earning per share is a basic indicator of the performance of the entity. Suppose if the EPS is increasing, that means the company is performing better. The earning per share is increasing. That means suppose if I invest 100 rupees in a company, suppose I purchased one share with 100 rupees value. Now this 100 rupees is generating how much earnings? So I will compare. For example, last year my 100 rupees earned 10 rupees profit. Now this year 15 rupees profit. So that means basically EPS is what? Earning per share. Profit per share. So the profit which is available to the shareholders divided by the number of outstanding shares. Then you will get earning per share. Now this earning per share is one of the important financial indicator. So that's why it has to be presented on the face of the P&L account as per Schedule 3. Now they have brought a separate standard to explain about this earning per share, which is Ind AS 33. Now basically I told you there are two types of EPS. One is basic EPS, another one is diluted EPS. How to calculate basic EPS? See, there is a formula. The formula for calculation of basic EPS is net profit or loss attributable to ordinary equity shareholders during the period. So equity shareholders, I am not talking about preference shareholders. Understand? See, this EPS concept is there for equity shareholders. So net profit or loss attributable to ordinary equity shareholders during the period divided by weighted average number of equity shares outstanding during the period. So net profit or loss attributable to equity shareholders during the period divided by weighted average number of equity shares during the period. So if you know these two things, then I think you can calculate basic EPS. Okay, so this is the formula. So simple formula you have to do. Now see, what is the first one? Net profit or loss attributable to equity shareholders. Sir, how to find out net profit or loss? Simple. See here. First you take profit before tax. From P&L account, take profit before tax. From that you reduce tax. Then you will get profit after tax, PAT. Now from that reduce preference dividend. Important. Because see, preference dividend you give to preference shareholders. So after giving preference dividend, whatever the profits remaining, that is net profit or loss attributable to equity shareholders. So you remember this, how to calculate. So suppose there is a question from AS 20. So you remember this one first, net profit or loss during the period attributable to equity shareholders. How to get? First PBT minus tax, profit before tax, less tax, profit after tax minus preference dividend. Then you will get net profit or loss attributable to equity shareholders. Now see, suppose for example, my profit before tax is 10 lakhs and my tax 30% on 10 lakhs, so 3 lakhs. Now PAT 7 lakhs. Now that from that PAT I need to reduce preference dividend 3 lakhs. I will get 4 lakhs. So what is this 4 lakhs? This is the net profit attributable to whom? Equity shareholders. Now see, when you take the preference dividend, you have to be very careful. Cumulative preference shares, non-cumulative preference shares. Suppose if the preference shares are cumulative preference shares, okay, then you should take current year dividend is deducted even it is not provided in the books. So whether they have not provided or not, you have to consider the current year dividend if it is a cumulative preference shares. In case of non-cumulative preference shares, you reduce preference dividend only if it is provided in the question, because we know the nature of the cumulative non-cumulative preference shares. Cumulative preference shares means generally the dividend will keep on accumulate, right? So in case of cumulative preference shares, so even if it is not provided in the books, you have to reduce the current year dividend. Suppose in case of non-cumulative preference shares, ignore. Only if they provide dividend is given, then you reduce, otherwise ignore. Okay, so this is the first thing about EPS calculation. So we are discussing basic EPS. Basic EPS formula is net profit or loss attributable to ordinary equity shareholders divided by weighted average number of equity shares. How to get net profit or loss attributable to equity shareholders? Simple, profit before tax minus tax, then profit after tax, less preference dividend. So in case of cumulative preference shares, whether it is provided or not, deduct current year dividend. Non-cumulative preference shares, only if it is provided, deduct. Then you will get net profit or loss attributable to equity shareholders. Okay, now there is problem also. So suppose for example in the question they have given the gross profit. Take gross profit, any other operating expenses, then you will get profit before tax 2,50,000. Now from that you reduce tax 75,000. From that you need to reduce what? Preference dividend. Then you will get profit attributable to ordinary shareholders. So what is the simple calculation means? PAT minus preference dividend. You remember this. PAT minus preference dividend is what? NP, net profit or loss attributable to equity shareholders. I think you remember this. Very simple now. PAT minus preference dividend, that is net profit or loss attributable to equity shareholders. So PAT minus preference dividend. Now the most important part in calculation of basic EPS is the second one, that is weighted average number of equity shares outstanding during the period. See, the specialty is generally when you divide it with the shares, you will not take outstanding shares directly. At the end, how many shares are there? I will take that. No. Standard says you should consider the weighted average number of equity shares outstanding during the period. That means number of shares, how many shares outstanding during the period. You should consider the time weight factor. You should consider the amount paid factor also. So two things you need to consider to calculate the weighted average number of shares. See here. First, see weighted average number of shares, how to calculate it. See here. Number of equity shares outstanding at the beginning of the period. Generally take how many shares are there in the beginning. Now for that add. If you have issued number of shares, add it. But see, add number of shares issued into time weight factor. You should multiply with how much time they prevail during the year, that shares. For example, we issued shares in the middle of the year. That means they are outstanding for 6 months. Suppose those shares are there from the beginning of the period. That means 12 months outstanding. So add number of shares issued less number of shares bought back. For example, see company sometimes may buy back its own shares. So whenever shares are bought back, so that has to be reduced. Now when you are reducing the shares, you have to reduce the number of shares into time weight factor. So this time weight factor is very, very important. Okay, for example, I have given some examples also here. See, for example, number of shares outstanding at the beginning 1 lakh, sir. Okay, now further issue, company on 1/10/2024 issued 30,000. Next bought back 1/1/2005 20,000 shares are bought back. Find out weighted average number of equity shares. Generally what students will do now, 1 lakh shares, further issue 30, add buyback 20 minus, so 1 lakh 30 minus 20, so 1 lakh 10,000. This is weighted average number of shares. Coincidentally it may be correct, but this is the wrong approach. So you should not do like this. So what you need to do is you need to find out weighted average number of equity shares. That means this number of shares is multiplied with the time weight factor. Sir, how to do it? Very simple. See, from the beginning, how many shares are there? 1 lakh shares is there. Into, suppose in a year there are 12 months, right? So it is there from the beginning of the year. So 12 by 12 you take. Suppose you issued further issue 30,000 shares. So 12 months. And when you have issued 1st October, November, December, January, February, March, 6 months you take. 6 by 12. You should take 6 by 12. That means 30,000 shares you issued on 1st October. Therefore, you should not take total 30,000. 30,000 into it is outstanding for 6 months. So 30,000 into 6 by 12. Therefore, 15,000 shares only will be part of weighted average number of equity shares. Similarly, when you are reducing buyback means the number of shares will reduce. So how many shares? 20,000 into from on January 1st, 2025, these shares are there from the company. So therefore, January, February, March, 3 months they have to be reduced. They are not outstanding for 3 months. So minus. So therefore, 1 lakh into 12 by 12, 1 lakh, 60,000 into 6 by 12, 15,000, and then 20,000 into 3 by 12. So it is 5,000. So therefore, 1 lakh plus 15,000 minus 5,000. So 1 lakh plus 15,000 minus 5,000. So it will be 1 lakh 10,000. This is the weighted average number of shares. So see here, this is how we need to calculate. See, date, number of shares, time weight factor. You see how I presented time weight factor, then weighted average number of shares. So suppose for example 1 lakh shares into 12 by 12. Further issue 30,000 into 6 by 12, that they are outstanding for 6 months, minus buyback 20,000 into 3 by 12. So therefore 1 lakh 10,000. This is how you need to calculate the weighted average number of shares. Then I solved some questions relating to it. Next, sir, sometimes what happens, sir, there are situations like partly paid up shares is there. Next, different nominal values there. Now in such a situation, how to calculate weighted average number of shares, we will see. First of all, what we are discussing, sir? Sir, sometimes in the question, sir, they will give you different paid up amounts. Like this, in this example, you see here. You see here. See here. In this question, you see, suppose, see, in the question, sometimes, at the time of finding out the weighted average number of shares, they may give different paid up values. Like, for example, in the beginning, 1/4/2024, 1,000 equity shares are there, face value 10, but paid only, paid also 10. That means this is fully paid up, right? Fully paid up. Now, next, 1/4/2024, 2,000 shares are there, 10 rupees face value, but see, 5 only paid. Now see, when I'm ascertaining the weighted average number of shares, how to ascertain weighted average number of shares? Tell me. Suppose opening 1,000 equity shares into time weight factor. It is there from the beginning. So therefore, into 12 by 12. So you consider 500, right? Sorry, 1,000. Now second one, you see, 1/4/2024, 2,000 shares are there. It is there from the beginning, 1/4/2000 into 12 by 12. But into, see here, it is not fully paid, it is partly paid. Now standard says, whenever you are calculating weighted average number of shares in respect of partly paid up shares, you should consider the proportionate value of the paid, the number of shares to be considered based on the, to the face value, how much you paid. Proportionately, you should take it. For example, 10 rupees is the face value, right? You paid only 5. So 50% you have to take. So important, Anna. See, in the last example, they have not we are not bothered about paid up value. That means face value, paid up value, same. So always when you are ascertaining the weighted average number of shares is multiplied with time weight factor. One thing, how many days or how many months it is outstanding, multiplied with that. And sometimes you have to multiply with amount also, paid up amount also. Suppose if they are partly paid up given, one is fully paid, another one is partly paid up shares given in the question. This partly paid up shares you should consider now. 2,000 into 12 by 12 time weight factor into 5 by 10. Out of 10 only 5 paid. Therefore you take 5 by 10. That means see here, 2,000 into 12 by 12 into 5 by 10. That means out of the total face value, how much you paid, you take it. So 1,000 equity shares. Therefore total weighted average number of equity shares is 2,000. Total weighted average number of shares is 2,000. I think you understood the concept. So how to calculate weighted average number of shares? Number of shares multiplied with time weight factor. How many months they are outstanding during the period, you multiply with it. Suppose if the shares are partly paid up, then you should consider it proportionately to the extent of the amount paid to the face value of the share. Like in this sum, for example, 2000 shares are there, but out of 10 rupees only 5 paid. Now you take 2000 into time weight factor into how much amount paid divided by face value. Okay. Now one more important concept, sir. Suppose how to calculate weighted average number of equity shares in case of bonus shares, share split, reverse share split, etc. See, when you are calculating basic EPS, what is the formula? Net profit or loss attributable to equity shareholders. It will not change. It will not change, sir, because see, net profit or loss attributable to equity shareholders. I told you how to get it. That is, take PBT minus tax. You will get PAT. From PAT, you need to reduce preference dividend. Then you will get net profit or loss attributable to equity shareholders. That will not change for any problem. Same. What is the thing which is constantly changing is weighted average number of equity shares. So that's why you should focus how many shares are outstanding during the period. The basic way calculation is take opening shares, add number of shares. Whenever you should add number of shares minus number of shares bought back. And but see, when you are taking number of shares, multiply with time weight factor, multiply with paid up value factor. If they are partly paid up. So that means if they are partly paid up shares, you take proportionately to the face value how much it is paid. You take proportionately. Then you will get weighted average number of shares. Now, suppose in the question there is a bonus share, there is a share split, there is a reverse share split. How to calculate weighted average number of equity shares? We will see bonus shares first. Sir, why you are discussing about bonus shares? See, because of bonus shares also number of shares will increase, na? So therefore, first we will consider the bonus issue. Okay. Sir, the speciality about bonus shares, share split, reverse share split is, in all these three situations, what happens? And there is a one more thing also, right shares. I will explain it separately. Bonus share, share split, reverse share split, what happens is, suppose for example, I have given one example here, see. Suppose 23-24, your net profit is 10 lakh rupees, sir. And weighted average number of shares 1 lakh. So therefore, what is the basic EPS? 10. Net profit divided by weighted average number of shares 10. Suppose next year 24-25, your net profit same 10 lakhs, but your weighted average number of shares 2 lakhs. Because there is a bonus issue, 1:1 ratio, company made a bonus issue. Now your weighted average number of shares is 2 lakhs. Now tell me what is your basic EPS? 5. Now tell me, last year EPS 10, this year EPS 5. By looking at this, what is your observation? EPS reduced, therefore the company performance is not good. That is the conclusion we will get now. By looking at this, we will say last year 10 rupees. That means last year one share earned 10 rupees. This year one share earned only 5 rupees. That means there is a decrease in number of earning per share. So prima facie, we believe that the performance of the company is not good. But here, if you see the net profit, same. That means company performance is constantly same, but EPS decreased. Why? Because of number of shares issued. Because of bonus issue. Because of bonus issue. See, because of bonus issue, what happens is, there is only increase in number of shares. There is no corresponding effect on the profit. How? See, because of bonus issue, there is no amount is collected. Na? When it is amount is not collected, how can you invest this fund in the business? How can it affect the profits? Suppose if shares are issued for consideration of cash, the cash is coming in, that cash we will put it in the business and it will affect my profits. But here I am issuing shares, but no fund is coming. Therefore, I will not invest. Therefore, it will not affect profit. That means it is not going to affect the net profit or loss attributable to equity shareholders in basic EPS formula, first one. But it is affecting the number of shares outstanding during the period. Therefore, the accounting standard 20 says, see, because of bonus shares, there is an increase in number of shares, but there is no effect on the net profit or loss attributable to equity shareholders. Therefore, users may mislead it that the company performance is not good. Because of bonus shares, only average number of shares increasing, but there is no corresponding increase in the profit. There is no corresponding effect on the profit. That's why standard says in case of bonus issue, what you need to do is you need to restate the last year EPS also, assuming that this bonus is there from the beginning of the last year. Why we need to assume like that? See, suppose if I am comparing 5 with the 10, my comparison is wrong. Why? Because I am believing that my current year EPS is 5, last year is 10, it is reduced. So 5 rupees it is reduced na. So 50% there is a reduction, I believe. But that is not correct here. Why? Because the profit same. Only because number of shares increase, so your EPS is reduced, and that too because of bonus issue. I am not issuing shares for consideration of cash. If I issued it for consideration of cash, the cash will coming into the business and it will put it in the business and it will affect my profits. Then no problem. But this is a bonus issue. It is not going to affect my profits, but it is going to affect my number of shares. Therefore, the basic EPS per share reduced. The users may believe that this performance of the company is not good. That's why in order to eliminate this negative effect, what they say is, suppose if this bonus is there from the beginning of the last year, what could be the last year EPS? You restate it and you show it in the current year financial statements. Suppose, for example, see here. Suppose restated EPS. Last year your net profit 10 lakhs. Suppose this year bonus issue 1 lakh na. This 1 lakh is there from the beginning of the last year. Last year 1 lakh shares plus this 1 lakh, so 2 lakhs. So EPS will be 5. So last year restated EPS will be 5. How? Last year profit 10 lakhs divided by last year shares 1 lakh plus this shares 1 lakh, so 5. So therefore now I compare these two, 5, 5. Now if I compare these two, then what happens? My performance is similarly same, exactly same. That means users are not misleaded. Users are not misleaded. Users are not misleaded. Now next, share split. Share split, reverse share split also same concept. Suppose what is share split? Suppose one share divided into multiple shares. Subdivision of shares into shares of smaller amount. Reverse share split means aggregating certain shares, consolidating shares into share of one value, larger amount. For example, see here. One share, sir, one equity share, suppose 100 rupees face value. Okay, equity share. Now what we have done is we split into 10 rupees. So 10 equity shares of rupees 1 each. Now you tell me, ultimately is there any effect on the total? Total no effect. One share is equal to 10 rupees. Here 10 shares is into 10 rupees, 100 rupees only. But what is affected here? Number of shares increased, you see. From 1 it has become 10. Now this is also have the same effect of bonus issue. How bonus issue is affecting my outstanding number of shares without having any corresponding effect on the net profit or loss. Similarly, it is affecting what? Similarly, it is affecting my number of shares. There is no corresponding effect on the profit, because when you make a share split na sir, so only number of shares will increase na sir, profit will not be affected. Therefore, in the question, if there is a share split, what you need to do is, how many number of shares increased because of the share split? Those number of shares are there from the beginning of the last year, and as if we need to restate the last year EPS and compare with the current year financial statements. Similarly, same happen with reverse share split. So therefore, weighted average number of shares, basic weighted average number of shares calculation. So number of shares outstanding into time weight factor. Suppose sometimes different paid up values is there, then number of shares issued into time weight factor into paid up value divided by face value. Then you will get weighted average number of shares. Suppose in the question, if there is any bonus shares, share split, reverse share split, you calculate basic EPS. Along with that, you need to restate the last year EPS also, because bonus issue, share split, reverse share split, because of all these things, your number of shares will increase without having any corresponding effect on the net profit or loss attributable to the period. Therefore, users may mislead it that the EPS has been drastically reduced. So in order to eliminate that effect, what they are telling is, you assume that these shares are there from the beginning of the last year and restate the last year EPS. Okay, then the comparison will be correct. See here, I have done some questions also relating to it. Now, the most important thing is right shares. Last time I think they have asked a question. See, listen. Suppose in the question there is a right issue. How to calculate weighted average number of shares? Simple. Sir, what is the difference between bonus issue and right issue? Bonus shares, total shares freely we are issuing. But right shares we are not issuing any freely. We are charging some amount. But we are taking amount, but at a concessional price. So therefore there is a bonus element in right issue. That bonus element will have a what effect? Diversion effect, dilution effect. See, what we need to do is EPS is reducing. Okay, see here, right issue means it is offered to the existing shareholders. When right shares are offered at a concessional price, so there is a bonus element in right issue, which we call it as right factor. Now, how to find out that right factor or bonus element? Simple, there is a formula. Fair value per share immediately prior to right issue divided by theoretical X rate fair value per share. So how to find out the right factor in right shares bonus element? Right factor is nothing but what's a bonus element, because this bonus element will have dilution effect. So there is a formula: fair value per share immediately prior to right issue. Immediately prior to right issue, what is the fair value per share divided by theoretical ex-rate price per share? How to find out this theoretical ex-rate price per share? Fair value of shares immediately before right issue plus proceeds from right issue divided by number of shares outstanding immediately after right issue. If you see this, this is similar to the valuation of right. In case of bonus and right issue, in the first part, Marthan I have released bonus and right issue topic. I told you how to value the right. The value of the right is cum right value minus x right value. That x right is there now. That is nothing but here. This is the same formula we have used there. Fair value of share, I mean cum right value of share before right issue. Nothing but fair value of shares immediately before right issue plus what is the proceeds from right issue divided by number of shares outstanding immediately after right issue. Now, if you find out if fair value per share immediately prior to right issue, you will give. You need to find out this theoretical x rate fair value per share. Now see, suppose for example, this is 50 came, this is 45. So 50 divided by 45. Now 1.11. So this 1.11 is the right factor, nothing but bonus element. Now what we need to do is, in right shares there is a bonus element, right? So this bonus element is there from the beginning of the last year. So that means the number of shares which is outstanding in the last year, we need to multiply with this bonus factor. Then including bonus shares, the number of shares will come, and according to the last year EPS will be restated. Sir, first of all, are you understanding what we are discussing? See, this is not the standard. Suppose if you are a first time listening this standard, this Marthan is not going to help you. So please understand, you should have the previous knowledge. See, this is the Marthan. Don't expect that everything will be discussed from the scratch. If I discuss like that, it will become a normal class and it will take a lot of time to discuss everything. Okay. So hope you already know something about this Ind AS, and I am discussing, I am quickly revising all the important concepts. Okay. So in case of right issue, what is the important thing, sir? In case of right issue, we offered shares to the existing shareholders and at a concessional price. So there is a bonus element. And that bonus element, how to calculate? Fair value per share immediately before right issue divided by theoretical x rate fair value per share. How to find out x rate fair value per share? Fair value of share immediately before right issue plus proceeds from right issue divided by number of shares outstanding immediately after right issue. See, there is one question also relating to this. So you please calculate it. Okay, you please do it. Problem number 8. So there we need to find out the right factor. We got 1.04. Now this 1.04, see here, we multiplied with last year shares and we reinstated the last year EPS. So the concept to understand is, in case of bonus shares, in case of share split, in case of reverse share split, in case of right shares, in all these 4 cases, what is the common factor is, there is one element which increases the number of shares but without having any corresponding effect on the profits. Therefore, what we need to do is, in all these 4 cases, along with the current year EPS, we need to calculate last year EPS also, assuming that these shares are there from the beginning of the last year. But the methodology of calculation in case of right issue is little bit different, because not like bonus shares. In case of right shares, we are issuing shares for a price, but at a concessional rate. So that concession is only the bonus element. So whenever there is a bonus element, what we need to do? We know that there is an increase in number of shares, but there is no corresponding effect on the profit. So this is my reducing my average EPS, showing false information to the users. Okay, see, when only number of shares are increasing without having corresponding increase in the profit, definitely your EPS will come down, and the users which you are looking outside, so they think that the company performance is not good. In fact, that is not the case. That's why what we are doing is, see, if this bonus is there in the last year, see, this will be our EPS. Now we need to compare this with the current year EPS. So we need to give proper information to the users. So that is the main intention behind this calculation of basic and right. See here, suppose last year EPS 2, normal EPS, current year EPS 2.5. Current year there is a right issue, 2.5. But shall we compare these two? No, answer is no. See, this is last year unaffected EPS. Now suppose if the bonus element is there, the right issue is there in the beginning of the last year, and there is a bonus element also, then your EPS is 1.92 only. Now we need to compare these two. Sir, current year there is a bonus element. There is a bonus element. Now if the bonus shares are issued, okay, so there is a bonus issue in the current year. And because of the bonus issue, what happens? Number of shares will increase. Now imagine a situation, if you are constantly earning the same profits, and if there is a bonus issue, because of that number of shares will increase, EPS will naturally come down now. So it indicates that the performance is not good when you compare EPS of the last year and current year. But that is not the correct indication, because we know because of the increase in number of shares, the EPS came down. So therefore we need to give the correct picture to the users. That's why what we do is, in all these cases means just there is an increase in the outstanding number of shares without having any corresponding increase in the profits, like bonus issue, right shares, share split, reverse share split, and bonus element in right issue. Understand, in right issue only bonus element will affect this, will having this character, because right shares you are issuing at consideration only, but there at a concessional price. So therefore that concession will have the bonus element that will increase your number of shares without having any corresponding increase in the profits. Therefore we assume that this bonus is there in the beginning of the last year, and last year EPS we restate and we will compare. We give the user that you compare these two, because current year there is a right issue. You may feel that because of the right issue, the EPS may come down when you compare with last year. So our performance may be bad. But remember, in right issue, there is a bonus element. Now, this bonus, if it is there from the beginning of the last year, this could be our EPS. Okay. Now, diluted EPS. Sir, what is this diluted EPS? See, simple. Suppose, in case the company is having any potential equity shares, suppose any financial instruments that may entitle its holder the ordinary shares, like convertible debentures. See here, convertible debentures, convertible preference shares, options, warrants. These are all what? Potential equity shares. If this potential equity shares is there in the company, and if these potential equity shares really converted into equity shares in future, what could be the effect of EPS? Suppose if after considering the effect of these potential equity shares, if the basic EPS is decreasing, then we say this is diluted EPS. Suppose instead of decreasing, the EPS is increasing, then it is called anti-dilutive. We need to ignore those potential equity shares which will have anti-dilutive nature. We should consider only those EPS which is having dilution effect. That means which will decrease as the existing EPS. And what is the formula for diluted EPS, sir? Diluted EPS is equal to net profit or loss attributable to the ordinary shareholders after considering the effect of conversion. Suppose if these potential equity shares are converted into equity shares, what will be the net profit or loss attributable to equity shareholders? Divided by weighted average number of shares outstanding during the period after considering the conversion. So basic EPS formula, net profit or loss attributable to ordinary equity shareholders divided by weighted average number of equity shares outstanding during the period. But what is diluted EPS formula? First one is net profit or loss attributable to shareholders, ordinary shareholders, that means equity shareholders, after considering the effect of potential equity shares. That means if these potential equity shares are really converted into equity shares, what will be the net profit or loss attributable? Divided by weighted average number of equity shares outstanding during the period after considering the conversion. Now, convertible debentures, convertible preference shares, options, warrant. For example, see, convertible debentures, 1 lakh, 10% convertible debentures, 100 lakhs is there. Okay. Suppose I convert them. Suppose if these are converted into equity shares, what will be the effect? Tell me. Suppose if debentures are converted into equity shares, suppose I can save, say, interest cost on this 100 lakhs, suppose 10%, 10 lakhs interest cost is saved. Now, the moment you save some interest, your tax liability will also increase now, 3 lakhs, 30% on 10 lakhs. So therefore, what is the net impact on net profit? 7 lakhs. So because of conversion of convertible debentures into equity shares, your net profit or loss attributable to equity shareholders increases by 7 lakhs and weighted average number of shares increases by 1 lakh equity shares. So therefore, if I consider basic EPS 25 by 5 lakhs, suppose 5. Suppose diluted EPS 25 lakhs plus 7 lakhs I have added. Why? Because this potential equity shares, if they converted into equity shares, okay, what will be the effect on net profit? 7 lakhs divided by what will be the effect on weighted average number of shares? 5 lakhs. So therefore, your diluted EPS is 3.2 lakhs. So if the potential equity shares are converted into equity shares, what will be the impact on the profits? What will be the impact on the number of equity shares? So if 1 lakh 10% convertible debentures of 100 lakhs converted into 1 lakh equity shares, what will be the effect? First, there will be savings in interest cost. How much? 100 lakhs into 10%, 10 lakhs. And what will be the tax liability? So because see, whenever you save interest, your taxable income will increase now. So there is a tax liability on this 10 lakhs. So 30% if I assume, so 3 lakhs will be tax liability. Therefore, what will be the net increase in profits? 7 lakhs. You add the 7 lakhs to the profits, normal profits, divided by weighted average number of shares 5. Now if I make the conversion of convertible debentures into equity shares, another 5 will be added. So therefore 3.2 lakhs is the diluted EPS. That means see, this potential this convertible debentures is having potential dilution effect, because basic EPS 5, now it is 3.2. Suppose instead of decreasing, if it is increased, na, ignore it, anti-dilution effect. Suppose similarly convertible preference shares. Suppose there is a preference shares 100 lakhs. We convert it into equity shares. What will be the effect? Tell me. You can save preference dividend. So to that extent your profits will increase, na? Because when there is a preference, there is no preference shares, you cannot require to pay dividend. So to that extent your profit may increase, and there is an increase in number of shares, but there is no effect on tax. Okay, so therefore if I consider both of them, then it is called diluted EPS. So I have solved certain questions also relating to them, and this is the concept, sir. So basic EPS, diluted EPS. What is the formula for basic EPS? What is the formula for diluted EPS? And I think in this standard, the most important thing is calculation of weighted average number of equity shares. So in different situations, how to calculate the weighted average number of shares. Sir, one more important thing, sir, here, whenever we see, we need to consider weighted average number of shares, right? That means we need to multiply the time weight factor. See, in different circumstances, from which date onwards we need to consider. So there is a table. For example, when shares issued for cash, so from which date onward these shares will be considered, because we need to multiply with time weight factor now. So for that, we should know how much is the from which date onwards we need to calculate the time period. Suppose if the shares are issued for cash, then the date of cash receivable. Suppose if the shares issued against conversion of debt instruments like convertible debentures, or date of conversion, or date when interest becomes ceases to accrue. Like that, they have given different situations. What is the effective date for calculation of time factor? So you read this table once. This is also important, may be asked as MCQ. Okay, so this is one of the important standards, sir. Comparatively, for the when you compare with remaining standard, this is lengthier standard compared to it, but easy only. So you have to spend some time. Okay. Now the next standard for discussion is Ind AS 37, sir, which talks about provisions, contingent assets and contingent liabilities. So 3 topics we are going to cover in this chapter. One is the topic of provisions, another one is contingent assets, another one is contingent liabilities. Provisions, contingent assets and contingent liabilities. So 3 topics we are going to discuss. First we discuss what is the object of this standard. See, the object is very simple, sir. This standard will provide the 3 things. One is recognition, measurement, disclosure. That means when we need to recognize, timing, what is the amount at which we need to recognize, and what is the nature we need to disclose. Relating to what? Relating to 3 things: provisions, contingent liabilities, contingent assets. So this standard will provide the recognition, the measurement, the disclosure of contingent provisions, contingent assets, contingent liabilities. Okay. Now see, next we discuss what is the scope of the standard. Sir, is this standard is going to cover all kinds of provisions, contingent assets and contingent liabilities? No, there are certain exceptions. See, this standard shall be applied by all entities in accounting for provisions, contingent liabilities and assets, except those resulting from executory contracts, except where the contract is onerous in nature. So anything resulting from executory contracts, any provisions, contingent assets, contingent liabilities arising from executory contracts, this standard is not applicable. But of course, if the contract is onerous in nature, this standard is applicable. Okay. First of all, what is this executory contract? See, executory contract means a contract in which neither of the parties has not performed their duties or performed to an equal extent. So a contract in which neither party has performed any of its obligations, nor, they performed obligations equal extent, performed their obligations to an equal extent. Now see, if the contract is executory contract, since neither of the parties not performed their duties or performed their duties equally, partially in an equal extent, then who can enforce the other? Nobody. Therefore, the standard says for these kind of executory contracts, this standard is not applicable. From these executory contracts, any provisions, contingent assets, contingent liabilities available, this standard is not applicable. Suppose if the contract is onerous in nature, this standard is applicable. Sir, what is this contract onerous in nature? See, simple. The cost of meeting the obligation is more than the benefits what we are going to get if the contract is fulfilled. So suppose there is a contract. According to that contract, I need to fulfill certain obligations. Suppose if I fulfill the obligations, I will get 10 lakh rupees. But the cost of meeting such obligations is 15 lakh rupees. Now that type of contracts are called onerous contracts. The cost of meeting the obligation is more than the benefits what I am going to get it. Now, if the contract is onerous in nature, this standard is very much applicable. So they may coin one question from this. If the contract is executory, that means neither parties has performed any duties or performed to an equal extent, this standard is not applicable. But if the same contract is onerous in nature, onerous means the benefits what we are going to get is less than what is the cost we are going to incur. For example, see, lease on a property that is no longer necessary but still cannot be sublet. For example, we have taken one factory for rent. Okay. Now suppose the lease period is 5 years. Okay. Suppose 3 years over. Now next 2 years. What happened is we constructed a new factory. Okay. Now we shifted from this old factory to new factory. But this 2 years rent we need to pay. Suppose this is a non-cancelable lease and we have to pay. We cannot sublet also as per the agreement. That means see, this 2 years rent per annum is equal to, for example, 1 lakh. So therefore 24 months into every month 1 lakh we need to pay. So therefore 24 lakhs we need to pay in the next 2 years. But what is the benefit we are going to get? Nil, zero. Because this factory either we cannot sublet or we cannot use it right now because we shifted to new factory. Now this type of contract is what? Onerous in nature. Now if the contract is onerous in nature, this standard is very much applicable. But if it is only executory, there is no onerous, it is not an onerous contract, then this standard is not applicable. Okay. So scope of the standard, this standard is not applicable if the contract is executory contracts. If the contract is onerous, then that is an exception. Exception. That means the standard is applicable if the contract is onerous in nature. And any provisions, contingent assets, contingent liabilities, if it is covered under other standard, like for example, Ind AS 12, 17, 19, 103, 104, 115, like for example, any provisions. See, I told you, if there is a specific Ind AS, follow that. Don't follow general AS. Okay. Ind AS 12, Ind AS 17, Ind AS 19, like for example, relating to leases. So any provisions we need to create. So there is a specific standard. Now follow that standard. Why you are following this standard? And this standard is not applicable to executory contract. If it is onerous in nature, this standard is applicable. This point I covered. Okay. So this is the scope of the standard, sir. Very simple. The standard has two exceptions. One is the standard is not applicable for executory contracts. Second, any provisions, contingent asset, contingent liabilities covered under other standard, the standard is not applicable. Now come to the first topic. What is provision? See, standard says provision is a liability of uncertain timing or amount. Important. Listen to me carefully. AS 29, this Ind AS 33 says what is provision? 37, sorry. What is provision? See, they say provision is a liability of uncertain amount or timing. See, there is a difference between normal accounting standard and this standard. Normal standard AS 29, if you read, sir, they say provision is a liability with a substantial degree of estimation. But here, Ind AS 37 has not used that word. Instead, they are saying that a provision is a liability with of uncertain amount or timing. Uncertain amount means we don't know the amount. So I think we will make an estimation. Okay. So a provision is a liability of uncertain timing or amount. We don't know when we are going to pay it. We don't know the amount also. See, uncertain means we don't know, or we know, but we don't know exact, and we can't say it is exactly the same amount. So basically, what is provision? Provision is a liability, and liability means when you are going to pay. Sir, we are going to pay maybe after 2 years, or maybe next year, sir. Maybe uncertain timing. Sir, how much you are going to pay? Sir, maybe 10 lakhs, sir. Uncertain word is main important. So what is provision? Provision is a liability of uncertain timing and amount. Sir, what is liability then? Standard says liability is a present obligation of the entity. Present obligation arising from past events and the settlement of which expected to result in outflow from the entity of resources embodying economic benefits. So provision is a liability with uncertain timing or amount. See here, uncertain timing or amount. What is liability? Present obligation arising from past events. Present obligation arising from past events and the settlement of which is expected to result in outflow from the entity of resources embodying economic benefits. Now, in order to settle this obligation, there will be outflow of resources. Sir, suppose there is an obligation, but it does not result in outflow of resources, then it is not a liability. So, to become a liability, there must be present obligation. And this obligation results in outflow. It is expected to result in outflow from the entity of resources embodying economic benefits. That means the organization resources must go out. Okay. Now, sir, what is obligation, sir? Because you said it is a present obligation. What is obligation? For example, obligation means a duty or responsibility to perform in a certain manner is called an obligation. And this obligation comes from obligating event. What is obligating event? Obligating event means a legal obligation or maybe constructive obligation. Constructive obligation means because of the policies you follow, because of the practices you follow, or maybe legal obligation because of the contracts, because of the legislations, because of law, because of contracts. For example, your company entered into a contract. Now, if you suppose you breach the contract, according to the contract, you need to pay some penalty to the other party. It's a legal obligation. Suppose, for example, the company is following one policy. According to that policy, suppose, for example, company need to pay certain amount to the other party. So therefore, it's a constructive obligation. So therefore, this obligation may arise either because of law, or maybe because of your own practices and policies you follow. So because of the policies and practices, if the obligation arises, that is called constructive obligation. If because of the contracts and obligation, the obligation arises, that is called legal obligation. So therefore, look at the things. So provision is a liability with uncertain timing and amount. Liability is a present obligation arising from past events and the settlement of which is expected to result in outflow of resources. Okay, embodying benefits. Next, present obligations means, sir, what is present obligation? An obligation is said to be present obligation if based on the evidence available on balance sheet dates, its existence on the balance sheet date is considered probable, more likely. Present obligation means on the balance sheet date, whatever the evidence we have, we can say that this obligation is probable, more likely chances that it may come. Sir, why this obligation means you cannot avoid. That means you have to pay it. There is a responsibility on your part. So therefore, on the balance sheet date, there is an obligation on you. That obligation is already present obligation. Either obligation is present or the more chances that it may come, more than 50%, for example. Why it is coming? Because of the legal obligation or because of the construction obligation. For example, there is a court case pending. Now, lawyer said 60% we are going to lose the case. That means there is a present obligation. Suppose if you lose the case, you have to pay penalty of 10 lakh rupees. Now, on the balance sheet date, whatever the evidence available, that's a lawyer's opinion, which says that there is a present obligation arising from past events and which results in the settlement of which results in outflow of resources. So therefore, it becomes a present obligation. Why it arises? Maybe legal obligation. Now you have to pay 10 lakhs. So you create a provision for this. So tell me, if you want to create a provision in the books, what are the 3 conditions you need to satisfy? See, if you read the definitions correctly, now the entire definitions, the 3 points you need to remember. When you are required to recognize a provision. So provision should be recognized three conditions must be satisfied. First one, there is a present obligation arising from past event. And then probable outflow of resources to settle the obligation. Sir, if you, read these two conditions, what's your opinion? Tell me, what is this? Present obligation with probable outflow of resources. This is called liability. You read liability definition, it involves two things. Present obligation is one. Second, outflow of resources. Two. If you add these two, liability. So that means, first of all, in order to create a provision, that must satisfy the definition of liability. Oh, sir, when a thing will become a liability, when whatever you are payable, what you are going to pay, when we will call it as liability. First of all, there should be a present obligation. Is there an obligation? Is it compulsorily required to pay? Is it obligation on the part of the company? First thing, you see that. Second thing, is this obligation involves outflow of resources to settle it? If these two things are satisfied, then we say liability. And once you said this is your liability, next you say liability with uncertain amount and timing. Then you say provision. Sir, there is a liability, sir, but we know exactly when we need to pay, how much amount we need to pay. Then it is not a provision, it's a direct liability. That's it. So a liability with the uncertain timing and amount is called provision. Understand it. See, why we use the word provision? Because there is uncertainty. Regarding what? Regarding the timing and regarding the amount. But first of all, it should be our liability. Sir, there is a present obligation. Obligation means something you cannot avoid. Okay. Suppose, for example, you sold goods on warranty basis. 2 years warranty you have given. The moment you sell the goods, there is an obligation. Because after selling the goods, 2 years warranty you have given. If anything happens to the goods, or if the goods are defective, damage, customer will come and ask you for the warranty. You have to do the free repairs or replacement. That's your cost, right? So there is a present obligation. The moment you sell, there is an obligation. And is this obligation results in outflow of resources? Yes. You have to appoint labor, you have to do repairs, you have to replace certain items. So there is a cost. So it is not necessarily that there should be an obligation. It must result in outflow of resources. Sometimes what happens now, there is a present obligation, but it does not result in any outflow of resources. Then ignore it. It is not a provision. Okay, so first of all, it should be liability. Liability with uncertain timing and amount is called provision. And why this obligation is arising? Because of the legal obligation or constructive obligation. Okay, now finally, when I need to recognize the provision, first of all, it should be liability. So satisfy two conditions. First, there should be a present obligation. Second, there should be outflow of resources to settle the obligation. Third and most important thing is reliable estimation of the amount of obligation. Reliable estimation. Sir, you said just now provision is a liability with uncertain timing and amount. Now you are saying reliable estimation. How reliable estimation is possible? See, the intention of the standard is we are saying uncertain amount and timing. That uncertain amount also you arrive through reliable estimation. That means the best possible evidence. You make scientific estimation. It is not something that some figure, I like number 7, okay, 70,000 is my liability, 7 lakhs, not like that, reliable estimation. So the intention of the standard is reliable estimation means, see, how you are going to ascertain your liability. There should be some reasonable basis, na. It should not be out of the air, then just like that, this is the amount. Suppose lawyer said, if you lose the case, we are going to pay 10 lakhs approximately. Now that is okay, lawyer said 10 lakhs. Now that will be perfect. Suppose, for example, if there is a breach of contract, in the contract itself they mentioned, if there is a breach of contract, how much amount we need to pay to the other party, then we can mention it. That is reliable estimation. So reliable estimation means it should not be some absurd or some unscientific calculation. You make some reasonable estimates and you write your assumptions, and based on that you arrive the obligation amount. Now that will be there. So they may ask a question whether provision is required to be created in this case or not. You have to see all these three conditions satisfied or not. First of all, there is a present obligation. Is there an evidence to say that there is an obligation for the company at the end of the balance sheet? Second of all, is this obligation requires outflow of resources to settle it? Third of all, can I make a reliable estimation? If you say yes to these 3 points, then you create a provision. That's it. Provision topic is over. Provision topic is over. So when we need to recognize a provision, 3 conditions: present obligation, probable outflow of resources, reliable estimation. If all these three conditions are satisfied, then we recognize the provision. Now you see here, a provision should be recognized when present obligation, probable outflow of resources, reliable estimation. They have given one example also. For example, XYZ is mining business. It operating in a country where XYZ is legally bound to clean and restore the environment on expiry of the lease after 10 years. XYZ can reliably estimate the amount required to restore the environment caused by the mining business. See, we are doing mining, sir. Now, as per the laws of that country, once the mining is completed, we need to restore the land where we have done some excavation, mining, etc. For that, we are estimating some cost will be incurred after 10 years. Since there is a present obligation, is there a present obligation? Yes. See, the moment you started mining, so there is a legal obligation on you. According to the laws of that country, you have to, restore it back to its original position whenever you are leaving, whenever your mining is completed. So you cannot avoid it. It is probable that resources will flow out of the business to settle the same. Definitely, to clean that, to restore it, you have to incur some expenses. So, and estimations can be measured reliably also. Your estimate in the question itself, in the example itself, they said how much, we are able to make the reliable estimation. Therefore, you create a provision. Okay. Now, what is the accounting treatment for a provision, sir? Provision, P&L account at auto provision. So, the provision is treated as an expense in the P&L account. So, okay, that's it. And in the balance sheet, we will show it as a liability. Remember, here the provision is on liability. See, students are not understanding what is provision. Provision is a liability. Suppose, for example, provision on debtors. That is not provision as per Ind AS 37. That is only adjustment to the asset. That's why that provision relating to assets we will reduce from corresponding assets and we will show it in the balance sheet. So there is a difference. Generally, provision means provision is a liability. Suppose if we create any provision on asset for reduction in value of the asset, like for example, provision for depreciation, provision for doubtful debts, any provision for diminution in the value of investments, all these are provisions relating to assets. This standard is not applicable. So when you create any provision relating to assets, reduce them from the corresponding assets and show it in the balance sheet. Okay. Hello my dear students, welcome everyone. So in Ind AS 37, in the previous session we have discussed the concept of provision. Now next topic of this standard is contingent liability and contingent asset. So if you discuss these two, the standard will become some miscellaneous topics also there. First we will discuss what is contingent liability. First of all, what is the meaning of the word contingent? Contingency factors, they say, contingent situations. See, we don't know what is going to happen in future. So the things what we expect may happen or may not happen. That is not in our control. Then we call them as contingent. For example, there is a matter pending in the court. Now the judgment may come in our favor or may not come in our favor. We don't know as of now. Those are called contingencies. Similarly, a liability which is not yet confirmed. In future it may come or may not come. That's why it is contingent liability. See, we have seen the definition of liability. A liability is a present obligation. Suppose if that present is missing, in place of present, possible came. That means on the balance sheet date, there is no obligation. But there is a possible obligation. See, as of now, there is no guarantee. Based on the evidence available, we can't say that there is an obligation. So that's why what is contingent liability? There is no contingent liability actually has two parts. It is defined in two ways. Or a contingent liability may come because of these two. First set of discussion is it is not a present obligation. It is a possible obligation. Second is it is a present obligation, but it does not result in outflow of resources. Because see, purely you see the definition of liability. If you see the liability definition, we discussed already. Liability is a present obligation with probable outflow of resources. See, I will tell you in the easiest manner what is contingent liability. What are the main two things about liability? When we say something is our liability, there must be present obligation. There must be present obligation. Second, probable outflow of resources. Probable outflow of resources to settle the obligation. Suppose this is missing, contingent liability, or this is there but this is missing, contingent liability. So there is no present obligation. So now it is no more a liability, it is contingent liability, because as of now there is no present obligation. An obligation may come, may not come, that's why it is contingent liability. Or there is a present obligation, on the date of balance sheet there is an obligation, based on the evidence available the existence of the obligation is considered probable, more than 50% chance that an obligation is there, created. But is this obligation really results in outflow of resources to settle? We don't know. So there is an obligation, but see, obligation itself is not sufficient. This obligation must result in outflow of resources, the settlement of which results in outflow of resources. Then only we call it as liability. Suppose there is an obligation. For example, one of the examples they say is guarantee given. Suppose our subsidiary company is taking a bank loan. See, one of our subsidiary company, for example X Limited, they are going for a bank loan. Now bank asked for guarantee. See, A Limited, which is the parent company of subsidiary company, has given a guarantee to the bank, guarantee on behalf of subsidiary. Now see, this guarantee means what? If subsidiary company has not paid the amount, we are giving the guarantee. Now the point here we need to understand is, we have given guarantee on behalf of subsidiary company. The moment we give guarantee, there is a present obligation. Already we entered a guarantee agreement, na? Based on that an obligation arises. But whether bank can enforce this guarantee as of now? No. Because as long as our subsidiary company is paying the amount, we are not liable. That means there is a present obligation, but there is no probable outflow of resources. So there should be present obligation, and this obligation, the settlement of which must result in outflow of resources. As of now you should be able to tell probable. Probable means more likely. You cannot say, sir, anyway we have given the guarantee, na sir, someday if they doesn't pay, we need to pay, na sir. Not someday. You tell me on this balance sheet, or is it probable, more likely chances that is there any amount will flow from the parent company? Answer is no. Because as long as our subsidiary company is making the payment, parent company is not liable. Suppose on behalf of your friend you have given bank guarantee here, so the moment you signed the guarantee paper, there is an obligation. There is an obligation. Obligation is created. You entered. You signed. That's it. Obligation is there. Present obligation. But is this obligation requires ultimate settlement? Is there outflow of resources as of now? No. Because you given guarantee on behalf of your friend will pay the loan. If your friend doesn't pay, then you are liable. That situation may come in future. As of now, there is no such situation. That's why it is contingent liability. That's why there is a present obligation, but there is no probable outflow of resources. So, to put it simply, what is contingent liability? Contingent liability is a liability, there is no present obligation. Or even though there is a present obligation, but there is no probable outflow of resources, then that is called contingent liability. Best example, guarantee is given on behalf of subsidiary company for any loan. Or maybe, for example, any case filed by third party against us, but we have not accepted the liability. Now we went to the court. Now the matter is pending in the court. Either we may win the case or lose the case. As of now, we don't know. So based on the evidence available on the balance sheet date, the obligation is not probable. So that means there is a possible obligation. As of now, there is no obligation. Possible obligation. Suppose if judgment is not coming in our favor, then there will be present obligation. This possible will become present. As long as it is possible, then it is a contingent liability. Because liability must be certain. Present obligation. Because standard says liability is a present obligation. But as of now, there is no present obligation. Because the matter is pending in the court. 50-50% chances. Suppose if you win the case, no need to pay. If you lose the case, you have to pay the damages to the other party. Whether you will win or lose, that depends upon future events which is not in your control. That's why see here, this definition what they are saying important. Contingent liability, possible obligation. See, possible obligation. That means there is no obligation now. In future may come possible obligation. And that obligation arises from past events here anyway. Even see, liability is a present obligation arising from past event. Even contingent liability is also not a present obligation, it possible obligation, but that is also coming from past events only. And whose existence will be confirmed by the occurrence or non-occurrence, either the occurrence or the non-occurrence of one or more uncertain future events, not wholly within the control of the entity. So, whether obligation will come into existence or not, which is confirmed only by the occurrence or non-occurrence of one or more future events, not wholly within the control of the entity. Not wholly within the control of the entity. So, as of now, there is no obligation. But in future, an obligation may come. And how will you know that the obligation may come or may not come? That depends upon the future events, occurrence or non-occurrence of one or more uncertain future events. Uncertain future events. That's why we don't know. Uncertain future events, not wholly within the control of the entity. They are not in our control. They are not in our control. So, occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Not wholly within the control of the entity. So, what is contingent liability? Possible obligation. What is possible obligation? An obligation is said to be possible obligation if based on the evidence available on the balance sheet, its existence is not probable. That means not more likely. That means the existence of the obligation is not probable as of now. As of now, there is no liability. As of now, there is no obligation. That is called possible obligation. See, what is possible obligation has been actually given here. See, possible obligation. An obligation is possible obligation if based on evidence available, its existence at the balance sheet date is considered not probable. Not probable. Based on the evidence available on the balance sheet date, they are not probable. Not more likely. Not probable. There is no present obligation. There is a possible obligation. Because if it is a present obligation, it will become a liability. That's why it is called contingent liability. So, contingent liability is a possible obligation. Obligation may come. For example, government has brought a new law. Now, according to that new law, you have to install some safety equipment to your factory. If you don't install, you have to pay penalty. Now, suppose you are in the current year end. Suppose still one more year time is there to install the equipment. Now tell me, is there a present obligation? No. Because still time is there. So, based on the evidence available on the balance sheet date, its existence is not probable. There is no present obligation as of now. And an obligation may come or may not come. That depends upon one or more occurrence or non-occurrence of one or more uncertain future events. Not wholly within the control of the entity. Occurrence or non-occurrence of one or more uncertain future events. Not wholly within the control of the entity. For example, a court case pending. Now suppose the judgment came in our favor, may not come in our favor. Occurrence or non-occurrence of one or more uncertain events, not wholly within the control of the entity. So an obligation that arises from past events and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Similarly, they are defining in another way. What is contingent liability? Present obligation. See, there is a present obligation that arises from past event, but it is not recognized. Why? Because it is not probable that outflow of resources embodying economic benefits will be required to settle the obligation, or amount of obligation cannot be measured with sufficient reliability. That means in order to recognize provision, three conditions are there. Present obligation, probable outflow of resources, reliable estimation. In that first one is satisfying, remaining two failing. Therefore, we should not recognize it as provision. It is a contingent liability. Or see, contingent liability can be defined in a very easy manner also. See, these three conditions are there. To recognize provision, we discussed the three conditions. Out of these three conditions, if the first one is missing, it is contingent liability. If the first one is satisfied but remaining two is missing, this is also contingent liability. So what is contingent liability? See here, the recognition of provision, there are three conditions, 1, 2, 3. If first one is missing, contingent liability. No need to see other two. If the obligation itself is not present, that's a contingent liability. Suppose out of three conditions, first one is satisfying, but either 2 or 3 is missing, either 2 or 3. If any one of these missing, then that is also contingent liability. This is also contingent liability. So therefore, what is contingent liability? Contingent liability is there is no present obligation. It is a possible obligation which will be confirmed by occurrence or non-occurrence of one or more uncertain events not wholly within the control. Or contingent liability is a present obligation. Present obligation, but it is not recognized. Why? Because there is no probable outflow of resources to settle that obligation, or it cannot be, a reliable estimation cannot be made. I told you, the guarantee is given. Best example, guarantee given. For example, as a parent company, you have given guarantee to the on behalf of your subsidiary company to the bank. Now, that means the moment you give a guarantee, there is an obligation, present obligation. But is it results in outflow of resources as of now? No. Only when your subsidiary fails to pay the amount, you need to pay the amount. See, they have given one example also. A customer of XYZ has filed a case against them for providing them wrong product and not returning the same. XYZ has taken a legal advice from their lawyer, who believes it is not payable. It is not probable yet that resources may be required to settle the same. That means we are not going to lose the case. Since it is not meeting all the criteria of provision, it will be treated as contingent liability and it will be just be disclosed in notes. Suppose one customer has filed a case against the company that you have supplied a wrong product and not returning the same amount, not returning the amount. Now, this XYZ Limited asked the legal opinion of the lawyer. So lawyer said, see, it is not probable yet that resources may be required to settle the obligation. As of now, we are not under the obligation. There is no present obligation. See, if that means 50-50 chances are there. Either we are not going to win the case or lose the case. As of now, there is no probable obligation. There is no present obligation. The moment he said there is no present obligation, that means there is a possible obligation. As of now, there is no obligation, but in future an obligation may come. Suppose according to the future developments in the court, suppose we may lose the case, or if the future developments of the case says that the other party, the customer, is winning, then maybe lawyer opinion will change and he will advise the company that now we are under the present obligation to pay the amount because we are under the losing side. As of now, there is no present obligation. Therefore, it will be treated as contingent liability and it just be disclosed in the notes. So, what is contingent liability? This is contingent liability. So, see, business point of view, think based on the evidence available at the balance sheet date, is there a obligation? No sir, no present obligation sir. Then don't recognize as a liability, it is a contingent liability. Sir, based on the evidence available, there is an obligation sir, but it is not result in outflow sir, outflow of resources. We are not required to pay anything to settle it. So any guarantee is given, so is the best example, guarantee is given is the best example for contingent liability. Because the moment you give a guarantee, there is an obligation, but it is not result in outflow of resources. Any case filed by the customer on the company, but company approached the court, that is also contingent liability, because the matter is in the court. We don't know whether we are going to win the case or lose the case. Even lawyer said 50-50%. Of course, if the lawyer said we are going to lose, more than 50% chances are there, then there is a present obligation, you have to create a provision. But as of now, there is no such thing. Lawyer does not said anything. 50-50 said he said. Or we are not, doesn't know. As of now, there is no requirement to pay, like that he said. Then we say it's a contingent liability. Okay. So liability with contingency is called contingent liability. So contingent liability can be defined in either it is a possible obligation, or there is a present obligation but it cannot be recognized as there is no probable outflow of resources to settle it, or the amount of obligation cannot be measured with sufficient reliability. Now sir, what is the accounting treatment of contingent liability sir? See, can contingent liability be recognized in the books? Answer is no. Contingent liability cannot be recognized, because in balance sheet we will recognize liability. But this is not a liability yet. In future it may become a liability. As of now it is contingent. So therefore contingent liability will not be recognized in the books. But maybe if the probability of outflow of resources to settle this contingent liability is not remote, then it may be disclosed in the notes to accounts. Important sir. Sir, see, as of now this is contingent liability. But if you have the gut feeling that definitely this contingent liability will become a present obligation and we need to pay the amount to settle it, then in such a situation, so you can recognize or you write the details relating to contingent liabilities in the notes to accounts. Otherwise no need to disclose in notes to accounts also. See, an enterprise should not recognize contingent liability. That means it should not recognize in the normal books, but it should be disclosed. Where? Notes to accounts. A contingent liability is disclosed unless the possibility of outflow of resources embodying economic benefits is remote. See here, when contingent liability is disclosed in the notes to accounts, unless the possibility of outflow of resources embodying economic benefits is remote. Remote means rare. Unless the possibility of outflow of resources embodying economic benefits is rare, no need to disclose in notes to accounts. That means what? If this contingent liability, in future it becomes a liability, that means it becomes a present obligation, and to settle it there will be outflow of resources. For this to happen, there are very rare chances, then not even recognized in notes to accounts. So contingent liability disclosed in notes to account, we should not recognize in the normal books of accounts. But if the probability of outflow of resources to settle this is very remote in chance, remote means rare chance, then no need to disclose in notes to accounts also. No need to disclose in notes to accounts also. Okay sir. So this is contingent liability sir. Contingent liability. As of now there is no liability, in future it may come. Okay. So therefore at the end of the day, anything like this, we are not able to, we are not sure. A liability may come or may not come. As of now there is no obligation, there is no present obligation, then you recognize them as contingent liability. And contingent liability you are not required to show anywhere. But in notes to accounts, if you feel this, it will result in outflow of resources. If the probability of, unless the possibility of outflow of resources embodying economic benefits is remote. That means if the possibility of outflow of resources embodying economic benefits is remote, that means to settle this contingent liability, the chances are very less, outflow of resources are very less, then no need to disclose this contingent liability in notes to accounts also. Now similarly, what is contingent asset? See, till now we have seen the liability, right? Asset now. See, like contingent liability, asset cannot be defined in two ways. Only one thing. Contingent asset means possible asset. As of now, it is not an asset, but it becomes an asset to us in future. For example, a case pending in the court. If the outcome comes in our favor, So we are going to receive some amount from the other party. So that is our possible asset. As of now, nobody knows anything. Lawyer said 50% chances. So a contingent asset is a possible asset. There, possible obligation. Here, possible asset. That arises from past events, whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. So this contingent asset is which asset? Possible asset. And the existence of which is confirmed by occurrence or non-occurrence of one or more uncertain future events which is not in our control. For example, we entered a contract with other party. Now according to that other contract, if there is a violation, if there is a breach of contract, and other party has to pay damages to us. Now for example, if the other party has violated the conditions and the matter went to the court. So we said there is a violation happened. The other party said no violation happened. So now as of now the matter went into the court. Now see, if it is proved that there will be violation, we are going to receive some amount. So contingent asset is a possible asset. As of now there is no asset, possible asset. And that arises from past events. Since we have entered the contract, this situation came. And whose existence will be confirmed? Sir, when we know that there will be asset, only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. One or more uncertain future events, not within the control of our entity. For example, a claim that enterprise is pursuing through legal process where the outcome is uncertain. Suppose for example, there is a legal process, we are making some claims, the other party, we don't know the outcome. So as of now, we can't say anything. Sir, what is the accounting treatment of contingent asset? See, like contingent liability, contingent asset is also not recognized in the books, and it is not even disclosed in notes to accounts. Even see, contingent asset at least will be disclosed as a part of notes to accounts. That means it is part of financial statements. It is not directly recognized in the balance sheet. But contingent asset, it should not recognize contingent asset. And it is not disclosed in financial statements. That means it is not part of what? It is not part of notes to accounts also. But where it can be disclosed, contingent asset may be disclosed as a part of board of directors report. Or in case company is having board of directors or any corresponding approving authority in case of any other enterprise, if the inflow of economic benefits is probable. That means this possible asset definitely will in future will become an asset, and there will be inflow of resources. And where the inflow of resources, inflow of economic benefits is probable, more likely chances. Sir, very less chances, sir. This asset we are not going to get anything, sir. Even though we are expecting an asset, but it is very rare chance. Management estimating that very rare chance that we are going to receive. Then not even required to disclose in board of directors report. So therefore, only if the inflow of economic benefits is probable means more likely, then we can disclose contingent asset in the board of directors report. So contingent liabilities may be disclosed in board of directors report. Of course, if the probability of outflow of resources is very rare, remote, then not even required to disclose in notes to accounts also. So many faculty suggesting that contingent assets and contingent liabilities are part of notes to accounts. Wrong. They don't know the standard. Contingent liability, they should not, automatically will not come in notes to accounts. Only if the possibility of outflow of resources is not remote, that means not rare. That means as of now it's a possible obligation. In future it becomes a liability, present obligation, and it results in outflow of resources. Then it will comes in notes to. If you feel that will happen with this, because as of now it is only contingent liability. Okay. Now same treatment, same manner in case of a contingent asset, don't recognize not even in notes to accounts. But contingent assets may be disclosed in board of directors report. If probability, inflow of economic benefits is probable. Inflow of economic benefits is probable. So, what is provision we covered? What is contingent asset? What is contingent liabilities we covered? And we have some miscellaneous topics, sir. Before going to miscellaneous topics, see in scope, I told you one point. See, this standard is applied by all entities in accounting for provisions, contingent liabilities, contingent, except those result from executory contracts. Except where the contract is onerous. Executory contracts, See, if the contract, except those resulting from executory contracts. What is this executory contracts? See, executory contract means where a contract in which either parties equally performed or not performed their obligations. Either of the parties partially performed their obligations to an equal extent, or they have not performed anything. Therefore, no party has the right to legally enforce other party since they have not performed or equally performed. That is called executory contract. See, executory contracts are contracts under which neither party has performed any of its obligations, or both the parties have partially performed their obligations to an equal extent. Now, see, when the contract is executory contract, if neither parties failed or neither parties equally performed, who will enforce who? That's why the standard says, because of the executory contracts, any provisions, contingent liabilities, contingent arises, this standard is not applicable. The standard is not applicable. Because see, the basic object of this standard is, whenever there is an obligation, so whenever one party can enforce the other party, either legally or through constructive obligation, then a provision, contingent liability, contingent assets will come. But here, if the contract itself is executory in nature, that means a contract under which neither party has performed any of its obligation, both the parties have partially performed their obligations. For example, A, B entered a contract. A said he will sell the goods. B said he will purchase the goods. For example, A doesn't, he is not sending the goods. B, even though A is trying to send the goods, B is not purchasing the goods. Or A, B has performed their duties only to equal extent. That means no party has the right to enforce the other party. That is called executory contract. Now, because of this executory contract, what provisions, what assets, what liabilities arises, the standard is not applicable. How can one party will enforce the other party? Only when other party failed to perform its obligations. But of course, when the contract is onerous, this standard is applicable. Sir, when we say the contract is onerous, see, the unavoidable cost of meeting the obligation under the contract exceeded the economic benefits what we are going to receive from the contract. Important, sir, this may be asked as a MCQ. Generally, when the contract is executory, this standard is not applicable. But if the contract is onerous in nature, this standard is applicable. What is contract onerous in nature? See, the unavoidable cost of meeting the obligations under the contract exceeds the economic benefits which we are going to receive from it. If an enterprise has a contract that is onerous, the present obligation under the contract is recognized and measured as a provision for this standard. Suppose, for example, see, I will tell you. For example, sir, we have taken one factory for lease. Okay. Now, this lease we have taken for 5 years. Now, suppose, for example, we shifted to a new factory. Now see, the moment we shifted to new factory, this old factory is no more useful. But as per the agreement, we cannot cancel this lease. There is no chance that we are going to cancel the lease, and we cannot sublet it. Either we cannot cancel it or we cannot sublet it. Now see, in this case, for example, the rent per month is, for example, 1 lakh rupee. Already 3 years contract is over. Now remaining 2 years contract is there. Now you tell me 24 months into 1 lakh rupees. So 24 lakhs we need to pay. And is there any economic benefits to us? No, nil. Because we are not using this factory. And we cannot sublet it to anybody. Now here, the unavoidable cost of meeting the obligation, 24 lakhs, is the unavoidable cost of meeting the obligation, is more than the economic benefits what we are going to receive. What is the economic benefits we are going to receive here? 0. So when the unavoidable cost of meeting the obligation is more than the economic benefits going to receive, then this standard is applicable and you can create a provision. So in this case, for this 24 lakhs, this is your unavoidable cost of meeting the obligation, so you can create a provision. See, that is what onerous contracts are contracts where the unavoidable cost of meeting the obligation under the contract exceed the economic benefits expected to be received under it. What benefits we are expecting to receive from it, and what is the unavoidable cost of meeting the obligation. If an enterprise has a contract that is onerous, the present obligation under the contract is recognized and measured as a provision as per the standard. So they will ask, suppose in this case, will you create a provision? Yes, present obligation 24 lakhs, you create a provision. So whenever the contract is onerous in nature, the enterprise has onerous, the present obligation under the contract is recognized and measured as a provision in this standard. Example, a lease on a property that is no longer necessary but it cannot be sublet, just now I said. So this is called executory onerous. So for executory contracts, this standard is not applicable. But if except where the contract is onerous, if the contract is onerous in nature, this standard is applicable. What is onerous contract? The cost of meeting the obligation is more than the economic benefits what we are going to receive it. The standard is applicable. Now we have some additional concepts like reimbursement, future operating losses, restructuring, then change in provision, use of provision, and then disclosures. Then comparative study, this standard will be completed. We need to discuss now the this additional points. So first concept, reimbursements. I think this concept we have little bit touched there. So what is this reimbursement? See, when we incur something, when we are going to incur something, if out of this amounts, some amount is coming from outside or some from other sources, that we call it as reimbursement. Suppose we have an obligation. Now, suppose according to that obligation, suppose for whatever the amount we are going to incur for that obligation, out of that some either part of the amount or full amount maybe come from outside sources as a reimbursement. So this reimbursement, it is like an asset for us. So what we will do is we will recognize separately in the balance sheet. Provision we will recognize separately, reimbursement we will recognize separately. Ultimately this reimbursement is for this provision only, So standard says, see here, an enterprise with a present obligation may able to seek reimbursement of part or all of the expenditure from another party. For example, insurance contract. For example, we are constructing a plant and machinery. Now for that we have taken an insurance. Now suppose for example, suddenly something happened to that plant and machinery. So a loss arises. Now out of that loss, some loss is covered by insurance company. So for example, that construction, that plant and machinery what we have constructing at the time of suppose something accident happened. Now some of our employees got injured. So we have an insurance. So we recovered some amount through insurance company. Now whatever the obligation arises now relating to that obligation, some of the amount is reimbursed by other party, either in the form of insurance contract or indemnity clause in the contract. See, in contract there is an indemnity clause. So if something loss happens, you have to reimburse me. For example, we have given a contract. Suppose for example, we have given a outsource. Okay. So 1 lakh units we given a outsource to another person. Now we accepted orders from customers. But this person to whom we have given the contract has not delivered the goods in time. Now because of the customers who gave the order cancelled their orders. Now we got some loss. Now in the agreement itself we have written that you have to deliver the goods within the time. Suppose if you don't deliver the goods, you need to indemnify the loss. Indemnity clause. That is also reimbursement, na? See, some loss, some obligation. For example, see, from customers we accepted the orders. If you don't deliver the goods in time, you have to pay some damages to the customers. Now at the same time, you have entered outsourcing contract. You have given a contract for somebody else to manufacture the items, give the delivery. Now if they don't give the items in time, you have to charge some amount from them. You are going to charge the amount. So there is an obligation for you, and at the same time, out of this obligation, some of the amount is going to be recovered from some third party, or any warranty provided by the supplier. Similarly, warranty sales. For example, see here. Suppose there is a manufacturer and there is a dealer, and this dealer is selling the goods to customer. Now suppose, for example, for these goods, if any damage happened, manufacturing defects are there in these goods. Now see, this customer will approach the dealer. Now dealer will make a requisition with manufacturer. Now see, dealer will create a provision, because provision for warranty he will create, because he is directly selling the goods to the customer. Suppose he created a provision for warranty 10 lakhs, and he knows that it is manufacturer goods he is selling, so therefore he will make the claim to the manufacturer. That means whatever the amount which is coming from the manufacturer, that we call it as reimbursement. So we have an obligation with our customers. We created a provision. Now relating to this provision, we make the claim from third party, reimbursement. So like there is an insurance contract, indemnity clause, or there may be a warranty. So organization, most of the times they will enter insurance. Definitely they will enter insurance, or they will take insurance on the lives of employees also. Suppose an employee who is working in the factory, something happened to him, we need to pay the amount, compensation. Suppose on that employee, company has taken insurance. Why company has taken insurance? To cover some of the risk, right? Something happened, we need to pay the amount. We are under the legal obligation. Now since you have an insurance, you can get some of the amount, reimbursement. Similarly, company enters a contract with indemnity clause, or similarly warranty. Supplier, as a supplier we may give warranty, or suppose as a dealer we may get warranty from supplier. Now suppose if customer, whenever we sold goods to customer, if there is any defects, now customer will ask the amount to us. So we will create a provision, and we will make a requisition with manufacturer. So the basis underlying the recognition of reimbursement is that any asset arising is a separate from the related obligation. The reimbursement should be recognized as an asset when and only when it is virtually certain that reimbursement will be received, and if the enterprise settles the obligation. In the statement of P&L, the expenses relating to provision may be presented net of the amount recognized for reimbursement. So this reimbursement amount, we will treat it as an asset. So when we need to treat it as an asset, only it is virtually certain that reimbursement will be received. We are going to receive this amount. It should be absolutely certain, virtually certain. And if the enterprise settle the obligation, we are going to settle this obligation, corresponding to which obligation we received this reimbursement amount. And in the P&L account, the expenses relating to provision may be presented net of the amount recognized for reimbursement. So these expenses we are going to adjust with this reimbursement amount. In most cases, the enterprise will remain liable for the whole of the amount in question, so that the enterprise would have to settle the full amount if the third party fails to pay for any reason. In this situation, provision is recognized for the full amount of liability, and a separate asset for expected reimbursement is recognized when it is virtually certain that reimbursement will be received if the enterprise settles the obligation. So we create a provision. We don't know whether the amount will come or not, we are not sure, but we are expecting that some amount is going to be received. Therefore, create an amount for full provision, and this reimbursement amount you recognized as an asset only when it is virtually certain that you are going to receive it, and if the enterprise settles the liability. Remember, you have to recognize reimbursement amount as an asset only if it is virtually certain that reimbursement will be received, and if the enterprise settles the liability. You have to settle the liability. Suppose, for example, you have taken insurance amount, but you have not given to employees, those who have injured. So that means you have not used this amount for the obligation. Then you should not recognize this as your asset. So therefore, it is virtually certain that you are going to receive, and after that you are going to use it for obligation, to meeting the provision, then you can recognize this reimbursement as your asset. In some cases, the enterprise will not be liable for the cost in question if the third party fails to pay. In such a case, the enterprise has no liability for those costs and they are not included in the provision. So this is called reimbursement. So what is reimbursement, sir? Any amount which is to be, coming from the other party in relation to this obligation. So either in the form of, best example is insurance, indemnity clause, or maybe warranty provided by the supplier. Now this reimbursement amount we will recognize as an asset. Provision separate, asset separate. But in P&L account, when you write expenses, so corresponding to this expenses you can adjust. At the end of the year, if there is any balance in reimbursement, we will recognize as a separate asset. And this reimbursement will be recognized only when it is virtually certain and you are going to use it to settle the obligation. Next, future operating losses. There is one more point. What is this future operating losses? Suppose, for example, we are expecting that there is going to be some losses in future. Operating losses, business losses. For example, COVID. After COVID now came. Now COVID over. Now we are estimating that after COVID our business is severely affected. There will be huge losses. So can I create a provision for that losses, future operating losses? Answer is no. Because future operating losses do not meet the definition of liability and the general recognition criteria. Therefore, provision should not be recognized for future operating losses. Suppose next year I am expecting that there will be losses, sir. Can I create a provision now? No. Because see, what is provision? Provision is a liability with uncertain amount and timing. Liability is a present obligation arising from past event. There should be a present obligation. But where is the obligation now? You are saying that there will be future losses, not now. So, in order to become a liability, there will be present obligation. Based on the evidence available on the balance sheet date, the existence of the obligation is considered probable. So, it is not satisfying the definition of liability, na? Because liability says there is a present obligation arising from past events and we are expecting outflow of resources to settle this obligation. We are expecting the settlement of this. And the general recognition criteria is also failed. Therefore, we will not recognize any provision we are not allowing any provision for future operating losses. Similarly, what is restructuring? I told you, restructuring is a program that is planned and controlled by management. See, management has planned something. A program that is planned and which is controlled by management, which materially changes either the scope of the business or the manner in which the business is conducted. I told you, when the organization, when the company changes the scope of its business, we call it as restructuring program. Example, any sale or termination of line of business. Suppose one of our business we are selling, or closure of business locations in a country or region, or the relocation of business activity from one country or region to another. Suppose we are closing our operations from, we are doing business in USA, so we are closing our operations in USA. Or we are relocating business activities from one country or region to another. For example, we are shifting from South India to North India. Or changing the management structure, for example, eliminating a layer of management. Suppose we are making changes in the management structure. For example, we are eliminating, suppose top level, middle level, below level, executive level. So we want to eliminate the middle level, directly the top management, top level and below level. That's it, executive level. Like that, in management structure, we want to bring changes. Fundamental reorganizations that have material effect on the nature and focus of the enterprise operations. And we want to change our nature and focus of operations. So we want to bring some fundamental changes, re-engineering of the organization, reorganization. Now see, we are seeing so many companies, they are making a fundamental reorganization. Now the old companies, now they are not cope up with the present environment. What they need to do? They need to do fundamental reorganization. That's why, otherwise they will not succeed, na? Suppose, for example, now it is e-commerce, so digital old. So every company has to do business online also. Suppose you are a company, old company, you are not doing business online, so you are no more there, gone. So every company has to change their nature and focus. Material changes they want to bring, fundamental reorganization. Now for that, whatever the changes they want to bring, that is also restructuring. So restructuring is a program which is planned and controlled by management. And what happens because of the restructuring? Either the scope of the organization will change, or the manner in which the business conducted will change. Okay, now see, suppose if any company announced restructuring, any provision for restructuring cost is to be recognized in the books only when the recognition criteria for provisions are met. What is the recognition criteria? Present obligation, probable outflow of resources, and reliable estimation. No obligation arises for the sale of operation until the enterprise is committed to the sale. That is, there is a binding sale agreement. For example, we want to sell one of our business operation. For example, Reliance company wants to sell its telecom business. Example, telecom business. Now tell me, is there an obligation? No. See, just because you are thinking that you want to sell the business, there is no obligation. No obligation arises for the sale of operation until the enterprise is committed to sale. That is, there should be a binding sale agreement. Then we say there is an obligation. So just because you have taken a policy, you have taken a decision, or you are thinking that you want to sell the business, it is not create any obligation. So there should be, whenever you announce any restructuring, whatever the cost you are going to incur for that restructuring in the organization, for that cost you can create a provision provided recognition criteria is made. And this restructuring provision should include only the direct expenditure arising from the restructuring, which are those that are both necessarily entitled by restructuring and not associated with the ongoing activities of the enterprise. That means which cost we need to include in the provision for restructuring? Only direct cost which is relating to the restructuring, and it is no way associated with any ongoing activities of the enterprise. So some expenses related to the future conduct of the business and are not liabilities for restructuring at the balance sheet date. See, this is important. A restructuring provision does not include such cost as retraining or relocating the continuing staff, marketing expenditure, investment in new systems and distribution networks. This point already came. See, whenever you create a provision for this restructuring provision, in that restructuring provision you should not include training cost, retraining cost, relocating the continuing staff, marketing cost, investment in new systems and distribution networks. These costs we should not include. Why? Because these are continuing activities. No way they are connected with restructuring. See, restructuring activity, how much amount you create a provision for restructuring? Only the expenditure which is directly because of restructuring and which is not associated with any ongoing activities. Tell me, your staff, you need to continuously give training and you need to relocate them one place to another. Wherever you require, you can relocate them. Marketing expenditure, investment in new systems, investment in distribution networks. So they are all part of the continuing activities, and in the above line they said not associated with the ongoing activities. These are all ongoing activities of the company. Therefore, they should not be included as a part of restructuring provision. So there is a concept called restructuring, and whenever company announces the restructuring, whatever the cost company is going to incur, for that they can create a provision provided those three conditions are satisfied. And this restructuring cost include only the direct expenditure because of the restructuring, and it is not include any cost relating to the ongoing activities of the business, like any retraining cost, any relocating of the continuing staff, any marketing expenditure, any investment in new systems, distribution networks don't include. Okay. Next, change in provisions. Sir, suppose once you create a provision, will you change? Yes, you have to change the provision based on the best evidence, because provision is only an estimation. That estimation will change. So provision should be reviewed at each balance sheet date and adjustment to reflect the current best estimate. If it is no longer probable that outflow of resources embodying economic benefits will be required to settle the obligation, you should cancel the provision, reverse it. See, one of the conditions to create a provision is a liability. Liability is a present obligation which requires outflow of resources to settle it. When no more outflow of resources is required to settle this, then no need to create any provision. And use of provision. A provision should be used only for expenditures for which provision was originally recognized. Only expenditure that related to the original provisions are adjusted against it. Okay. So for which we created a provision, only that expenditure we need to adjust. Remaining other expenditures we should not adjust. And some disclosures. For each class of provision, enterprise should disclose. What they need to disclose in the notes to accounts? The carrying amount at the end and beginning of the period. So suppose at the beginning of the period, how much is the provision? At the end, how much is the provision? We need to disclose. Additional provision made during the period, any additional provision we created, we should disclose the additional provisions in notes to accounts, including increase of the existing provisions. Any amounts used, that is incurred or charged against a provision during the period, that means any amounts we are going to incur out of the provision what we have created, and any unused amounts reversed, we need to disclose. And in respect of contingent liabilities, what we need to disclose is, unless the possibility of any outflow of settlement is removed, an enterprise should disclose a brief description of the nature of contingent liability, and where practicable, an estimation of its financial effect and indication that uncertainties relating to any outflow. So relating to contingent liabilities, we need to disclose. So what is the nature of this contingent liability, what is the financial effect, and what are the uncertainties